sectors, but the point being that they've done pretty well. The Mag 7's done pretty well. Watching to see whether we take out those all-time highs then on the Stock 600 as the S&P over in the United States took out another all-time high or closed at another all-time high in yesterday's session. So that's the positive backdrop in terms of risk assets as we get these markets open for this Friday morning. So just opening up then for European stocks. The FTSE 100 just up a touch at the start of trade, waiting for other markets to open up. It is a quieter day, Critty, in terms of the earnings stories. We've been through a lot of them. Buybacks has certainly been a theme that we've been covering this quarter. Resilience in the C-suite, also a theme, dealing with all kinds of complications around the Red Sea, for example, in some businesses, but not necessarily struggling with those logistically. The Stock 600 then up by 0.2%. The CAC 40 up by 0.4%. The FTSE now up by 0.6%. So we're certainly going higher on these markets.
Yeah, let's talk about some of the early movers. And again, we have to say that it's been less than a minute in terms of this open, but there were some indications in kind of trade gate pricing as well. Diageo, for example, coming right out of the gates as one of your biggest index contributors to the FTSE 100. Doesn't seem to be any fundamental reason here outside of the fact that the ADR has actually rallied in a really big way in the overnight session. So perhaps some residual effect of that this morning as well. But then you've got a little bit of commodities names in there as well, Anna. Rio Tinto higher by 1.6%. ASML, some tech pieces. Glencore coming in and out of that early pricing. But on the back end, your stocks underperformers are going to be a lot of your healthcare space, to your point. The Roche story, the Sanofi story as well. Not to mention, I could have sworn Novo Nordisk, there it is where you're seeing as well. Airbus to me is interesting because it's having a very volatile week. This morning, only down 0.2%.
Yeah, some volatility around those numbers. But of course, when your major competitor has effectively had their production capacity capped by regulators, that's going to complicate things, or perhaps in your favour. So that's where we are on the overall story. Looking at that sector's picture a little more, yes, basic resources very much to the fore, up by 1.2% there. The likes of Glencore, Rio Tinto. I wonder whether the China expectation, obviously we don't have markets open in China right now, the Lunar New Year holiday, they reopen next week, and there has been some talk about whether we might see some supportive measures coming through from Chinese authorities, aware that they might want to make a strong start to the year for stocks. I know that iron ore prices are up by 1.4%. They have been over in Singapore, so that's adding to perhaps some of that positivity. But yes, the FTSE 100 perhaps benefiting then from the strength that we're seeing in some of those commodity prices.
Yeah, let's talk about another company that we haven't maybe given enough love to this morning, which is Swiss Re. You're seeing a big move down, about 3%. It's contributing. It's one of your worst weights on the Stock 600 this morning. Their results actually coming in fairly positive when you look at the surface level there. It looks like their full-year profits soaring. They're really citing those higher interest rates is really helping their bottom line. But when you look at what the analyst calls say around some of those numbers, it's that even though these numbers are pretty good, they've hit those early yearly targets, it's their property and casualty unit that is taking a bigger hit than expected. Perhaps that's what investors are responding to this morning.
Yeah, absolutely. Morgan Stanley analysts talking about the fact that management needs to clarify the nature of the reserve charge that they've taken in their business. And so that's certainly something we'll look to do a little bit later on when we're talking with Swiss Re management. But you're right to point out that it seems to be the property and casualty area. The results seen then as mixed by analysts, with property and casualty coming in a little below expectation. RBC saying those ongoing developments in casualty might still prove to be unnerving to some in the medium term. And we will certainly be speaking to the Swiss Re CEO later later on this hour. That's Christian Mumenthaler joining us on this program.
Yeah, and does it then show some sort of indication? And we keep talking about this with not just with SWE, but with some of the bankings as well, Commerce Bank, NatWest as well. As what happens if they're citing that higher interest rate as the reason for all this growth? What happens when interest rates go in the opposite direction? Is this then not only a peak in interest rates, but a peak in those profits?
Yeah, absolutely. And that takes us nicely onto the NatWest story. We're seeing that share price down by 1.5% this morning. Concern around where the profitability story goes next. They're saying revenue is likely to drop this year as high rates bite. So actually, this is more about the higher rates necessarily than the cuts. But let's get the link then between the rate environment and the profitability of this business with William Shaw, Bloomberg's William Shaw, who covers this business for us at Bloomberg News and can join us with key takeaways on these numbers. William, give us your take on this guidance, saying that revenue is likely to drop this year as high rates bite. What are they referencing there? And take us into the net interest margin story.
So they reckon, they now reckon that revenue for this year is going to come in a range of £13 billion to £30.5 billion. Now that compares with £14.7 billion in the previous year, and it's a larger drop than, or a larger projected drop than analysts had anticipated. There's somewhat a projection of a sense of gloom here, even at a time when NatWest is preparing for a potentially historic sell of its shares to retail investors, which is likely to be the biggest privatization of the year.
William, talk to us a little bit about the management change as well and what that strategy might look like in terms of the macro that you were just talking about. A new appointment of Paul Thwaite as permanent CEO. What does that actually mean in terms of strategy for the bank?
So obviously there's been a lot of drama around NatWest in the last 6 months or so after the Nigel Farage debanking scandal. Paul Thwaite is very much a continuity candidate. He's been at the bank for many years. He's perceived to be a safe pair of hands. And there'll be hope that he provides stability at this time when the government is seeking to ditch its remaining share in the bank, which it bailed out during the financial crisis. The government still owns a little over a third of NatWest. There's a lot of excitement about this share sell-off. It's being compared to some of the privatization efforts in the 1980s, which turned out to be defining moments of the Margaret Thatcher era. So the stakes for the government and implicitly the stakes for NatWest as well are quite high.
Yes, I was going to ask you a bit more about that, William. Tell us a bit more about the expectations there and when we get something from NatWest around this. As you say, this is still a legacy of the post-GFC or the GFC era, really, the fact that the government still owns around 35% of this business.
Well, we know that Barclays Bank have been signed up to get involved. Goldman Sachs are also playing a role. Saatchi & Saatchi, very famous advertising company from the 1980s, are going to be involved in trying to sell it to the general public. We should get further details in March during when the budget is announced. I think everybody is just wondering, like, how is this going to be pitched? Given that, in particular, you can already buy shares in NatWest if you're a retail investor. People are keen to compare it to the Tell Sid campaigns in the 1980s, where things were being privatized. It was something completely new. Here, as a retail investor, you can buy shares today. So why should you wait? Why should you wait until they run a big campaign and then do it? I mean, obviously there'll be a lot of focus on it, not least because it's coming in the run-up to the general election.
Yeah, the politics and the sort of culture watch stories will be really interesting, won't they? Bloomberg's William Shaw, thank you very much. Yes, as he points out, Chrissy, you can already buy shares in NatWest. As you say, 35% owned by the government. That leaves a lot that isn't, and a lot of that trading. And you can see that trade on the Bloomberg terminal. Interesting, though, the point around interest rates, because for a lot of these banks, we watched them do well as interest rates were on the rise. Yeah. And the expectation is they do worse as they come down. But here's NatWest talking about higher interest rates damaging. And what's interesting in the write-up that William gave us this morning, he's pointing out that what this does, it spurs competition for deposit customers, and NatWest has said that they see more customers shifting into fixed-term accounts to take advantage of those better rates, and so there isn't necessarily that kind of immediate path-through of lower rates.
It's interesting because it's such a divergence from what you're hearing about kind of the exposure and the mix that you have from a lot of these, even Wall Street banks, but I would say banks around the world, because one of the things we had talked about with UniCredit, with Santander as well, is that how much exposure do you have to the end consumer as opposed to real estate, for example, or as opposed to kind of emerging markets and the carry rates there as well. NatWest very clearly more exposed to that consumer story. So if consumers are getting hit, then NatWest is getting hit. And that's not something that some of their European and I would argue global peers necessarily share in common.
Okay, let's have a look at how the NatWest shares, and they are trading, and see how they're trading. Let's go to Joe Easton, who's got an update on this and other movers this morning. Joe?
So here's NatWest stock currently down around 0.6%. It was down a bit more of that earlier. As Will was explaining, it is the downgrade to the revenue target driven by interest rates. Now, analysts at Citi describing this as a kitchen sink report, i.e. they've thrown in all the bad news now, try to get it out of the way and hopefully reset analyst expectations on that one. We can see it ticking up even higher now, so almost unchanged for NatWest now. What's interesting is we're not seeing a read across in the other peers. The UK banks not reacting, and that is notable given that they are all reporting next week. We can see NatWest ticking positive for a brief moment there, so not a huge negative reaction, but as you've been discussing, it is the revenue outlook that is looking weak due to those interest rates at the moment. Then in terms of Swiss Re, we had it in stocks to watch, a positive update. The investment income is better than expected, but it's already rallied into the report, and as such, we're seeing it coming down 1.7% at the moment, putting focus on all of the reinsurers today. We've got a couple of industrial stocks as well. Sika, a massive maker of components for the construction sector, that one coming up 3%. They've got earnings out as well, looking pretty positive on that one today. And Umicore, the maker of battery materials, a weak one once again. They're exposed to EVs, and they've got some negative commentary about their end market demand in their update today, so that one is declining. And another one slipping, this one over in France, it's Covivio. This is a real estate firm cutting their dividend this morning due to the decline in asset valuations across the real estate space, and that has become a big sector of worry at the moment. Then we'll take a look at the stock of the week. Temenos down another 3% today, that looks like to me, and we can see the two-day slump on that stock. It is a massive drop for that one. As we said earlier, they've got a capital markets day next week. Well, they'll look to counter these accusations from Hindenburg Research, which went short the stock, spurred a record 30% drop yesterday. It's declining. We're not seeing a rebound in that one, quite surprisingly. Temenos weaker again over in Switzerland.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those movers this morning. Coming up, we go back to the macro. How do you like your rate cuts? Early, late, somewhere in between? The ECB cannot seem to decide. We're going to get the opinion of Jane Foley from Rabobank next. Stick with us. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
We do not have enough evidence yet to have the level of confidence that we are going to hit our medium-term 2% target and that it will be sustainably there. The last thing that I would want to see is us making a hastily decision to see inflation rise again and have to take more measures.
ECB President Christine Lagarde speaking yesterday to European Union lawmakers. Plenty of other voices on the ECB have been speaking out. We heard there from Christine Lagarde. We've had plenty of other voices as well giving us their thoughts on how quickly or slowly we need to get to rate cuts in the Eurozone. Let's bring in Jane Foley, Head of FX Strategy at Rabobank, to help us see the wood for the trees here and help us get through a lot of this. So we heard from Christine Lagarde, Jane, good morning, talking about not being hasty, and that does seem to be a message that we're still hearing from the ECB. Back in Davos, we heard about the summer, and a lot of voices still saying, you know, there are dangers with going too soon. What are you factoring in? What are you expecting to be the case for the ECB?
Well, you know, I think it's quite simple. In fact, I think you could put this argument to many of the central banks right now. Nobody wants to go down in history as the central banker that made a mistake, that cut rates too early, that allowed inflation to pop higher again. No one wants to make that policy mistake. So risk-reward, it's going to be much better for them just to hold on a little bit longer and then maybe, over the medium term, potentially cut rates a little bit faster, perhaps, than they would expect it. So I think that's the way they want to go. And I think for many of these G10 central banks, it's all about service sector inflation. We had a nice definition, I think, from the RBA this month, which suggested that service sector inflation was inflation on anything you couldn't drop on your foot. So that was how...
Hang on a second. Lunch?
Well, maybe. So that was how Bullock defined it. And I think, again, service sector inflation is basically correlated with wage inflation. And you know, we can bring it right back to the ECB because that is what they're very much focused on. That's what we've heard before. They're still worried about the tightness of the labour market, which, of course, is related to demographics. And they're worried that that could be just a little bit problematic and sticky.
So services, inflation, wages, very much front and centre for the ECB. We watch that. And is your case sort of underscored by the fact that this is, as Mark pointed out to us earlier, it's a single mandate central bank. And so they are excused for focusing perhaps singularly on inflation, but they must have an eye on that, you know, stagnating growth story as well.
They certainly would do, but the problem, I think, in this particular business cycle is that, yes, we've got stagnating growth, and yes, we've got, you know, the vast need for structural reforms in Germany in particular. I mean, that economy, it really is suffering right now. But the problem is that the labour market is tighter than you would normally have it in other business cycles and previous business cycles. So, and it's tighter because of the ageing population, for instance, almost 20% of us in Europe are over the age of 65. You know, that's an issue. So you don't have the labour market looseness to generate that downside pressure on wage inflation, services and pressure that you would have in previous economic cycle. And that's the difficulty for them.
Jane, one of the big questions around here is what does it actually mean in terms of market pricing? We had Althea Spinozzi over at Saxo Bank, the head of fixed income strategy there, kind of putting a floor and a ceiling on where 10-year yields itself could go. Take a listen to what she had to say.
We believe that the 10-year U.S. Treasuries is going to fluctuate between 3.5% and 5%. So 5% is the worst case scenario in case the bond market believes that inflation is not under control and the Federal Reserve should stay on put for longer.
Althea, they're talking about 3.5% to 5%. That's a pretty wide range that it could kind of go anywhere. But what does that mean in terms of the translation to the dollar trade? Is it still interest rate differentials that's driving it?
Interest rate differentials certainly huge. I mean, we know that there's lots of other things on the periphery. We've got geopolitics, we've got politics, for instance, and this year particularly an awful lot of that going on. But it is really interest rates differentials, and I think really it's still very much about the Fed. The ECB obviously very important, but perhaps of secondary importance to the market, focusing on the Fed and what are they going to do. And, you know, we saw the reaction yesterday when we had the retail sales data from the US, you know, a surprise there, the market wanting to believe that the Fed can bring forward its interest rate cuts. But we suspect that they probably won't, that there's not enough data, that the labour market is still relatively tight from a historical basis, and that they won't bring that forward. So we still think there's a bit of extra dollar strength going to come through as the market is forced to price out those cuts a little bit further. And the euro, of course, is a weak, stagnating story.
In terms of that stagnating story, though, why are we not seeing it crack faster? Even though we're seeing, yes, a lot of it is dollar-driven, euro strength seems to be a trend across the board. What kind of time frame are you looking at for that to snap?
So, you know, that I think is a very interesting question. Now, if we go back to the end of last year, we had euro-dollar around about 111 or so. So we've trended lower. But every time we've trended lower, so every time we've had, you know, a big piece of news, maybe it's the blowout payrolls report, maybe it's the CPI, we've had euro-dollar going lower, and then it gets stuck, and there seems to be buyers appearing for euros. So it's almost as if no one really wants to buy the dollar
at which level is the stuff?
Every time it's gone down. So every time from 111 since the end of the year. So we've trended lower this year in euro-dollar, but it's almost a reluctance by the market to buy the dollar at these levels. Now, possibly that's because the market still thinks that the Fed is going to cut at some point in the future. But I think that the dollar can strengthen, but there is clearly a reluctance by the market to want to buy the dollar too heavily. And I think that is linked with the fact that the market still wants to believe that the Fed could cut more aggressively than we think it will.
Yeah, absolutely. So how long do we wait then for those rate cuts, Jane? Because it seems, you know, the start of the year, we were talking about spring. That's gradually getting priced out. It's looking more like summer. And you wonder what happens to those persistent calls for rate cuts in the second half of the year now. I mean, how long are we going to have to wait, do you think?
Well, you know, the Fed has said 3 this year, the dot plots. Our expectation is 3. Our expectation for a long time really has been they'll go in June. There's no particular reason for us to alter that view now. And I think there's perhaps a little bit many more people in the market coming round to that view. March is, you know, more or less gone. But I do think we have to watch the inflation indicators carefully, watch the labour market very carefully. And, you know, right now, you know, I think there will not be any more than 3.
Okay, so 3 is the number there. Lots of other central banks wrestling with similar but different dynamics. The UK springs to mind there, of course, as well. We've had plenty of data out from the UK this week, from sticky wages to underwhelming, but that's a good thing, inflation, but still double the target. We've had the recession confirmed, of course, and retail sales looking pretty strong, actually, for the month of January. Put all that together in some kind of cable strategy for us, or pound strategy more broadly.
Well, in a way, perhaps, you know, we can see that very much in the way that cable traded on the back of that strong retail sales data this morning. It went higher. But it couldn't really hold all of those gains. And actually, if you look at the breakdown, if you look at what the ONS was saying in terms of that retail sales data, yes, it rebounded really strongly, but from a very weak December. It seems that people bought their Christmas shopping early into November, and yes, they've come back and they've bought again in January. But the trend, if you look at the 3-month trend, well, it's really not all that. And in terms of volumes, retail sales volumes rather than values. Values, of course, driven up by the price level being driven up, but volumes still not great compared with where we were before the pandemic. So I still think that we're just moving on. Now, in terms of the recession, we've already had Andrew Bailey saying, yes, well, we think that in terms of forward-looking indicators, we've already sort of moved away from some of that weakness. And we've got to remember that although all of these labour markets are loosening, they're still relatively tight from a historical basis. And that means that, you know, demand in all of these economies has been given a sort of a floor because most people still have work.
Yeah.
You just mentioned a floor. Is there a ceiling on cable?
Yes, I mean, we think it could potentially get to 130 at the end of the year, maybe beginning of next year, assuming that the dollar gets up some of its strength. So that would be when the Fed's interest rate cutting cycle gets underway. But I struggle to see it really beyond there, given the headwinds to growth that we have.
And so higher inflation in the UK will keep the Bank of England from cutting at the same timetable as the Fed?
Correct. That's what we think. So we don't think that the Bank of England can start till September.
Okay. Thanks so much, Jane. Thank you very much for joining us. Jane Foley, Head of FX Strategy at Rabobank. We thank Jane for joining us this morning. And let's have another look at what is coming up today on your trading calendar. We are focused, and we are attending, in fact, the Munich Security Conference. That sees key figures from government and industry gathering in Bavaria to discuss threats to the world. At 1:30 p.m. UK time, we get US housing starts data. 3 p.m, the University of Michigan Consumer Sentiment Survey. We've also got PPI data coming out of the US. 7:40 p.m, Bank of England Chief Economist Hugh Pill speaks on global monetary policy in Washington, D.C. It will be interesting, I think, to hear from Hugh Pill after this week of data and confirmation of recession in the UK. I'm sure he'll try to stay away from the politics of it, but certainly there's a lot to be said about the data in itself. And then, of course, there's the US data picture. Interesting, Mark didn't think there'd be anything in PPI or the Michigan Consumer Sentiment that would change, that it was big enough, I suppose, to change the market's thinking, as entrenched as it is right now.
Well, to be fair, there's two arguments here. There's one that one data point doesn't matter. You're pulling a page out of Chair Powell's kind of playbook here, whereas perhaps for the UK, there might be a little bit more sensitivity to each individual data point, especially given the resilience that you're seeing in the UK that I don't think a lot of people saw coming. That being said, it really comes down to kind of the nerdy, wonky math that Anna Wong over at Bloomberg Economics is consistently pointing to. The idea that it's not PPI in itself, it's what does PPI give us an early insight to on the PCE, simply because the CPI numbers don't contribute to PCE the way that PPI does. So again, it gets very nerdy to have that sensitivity in there, but ultimately, I think Mark's right in that the PCE might matter more out of all three data points.
Yeah, of course, because we get these reminders, after the CPI, a lot of people thinking, well, where does that leave our Fed expectations? And yields went higher as the market priced out some of those Fed rate cut expectations. But yeah, then very quickly voices appear saying, well, don't focus too much on CPI, focus on the PCE, focus on PPI, to your point. And the PCE has been less volatile than the CPI. It didn't go up as much, of course, and it is the Fed's preferred gauge, we know. But you've been making the point that it hasn't necessarily moved in line with some of the other most recent data as well, the PCE.
It does, and you've seen the volatility just kind of show up in the data, which makes it really hard to say this deceleration process is a one-way street down, as opposed to the fact that maybe there is some sort of resurgence in inflation, whether you're seeing it in the producer numbers and the consumer numbers. That was a theme last week where you started to see some analysts around Wall Street and abroad saying that, well, maybe there could be some reacceleration, but we're not there yet. It's more of a end of 2024, early 2025 story, if it indeed actually manifests.
We're going to talk about some geopolitics shortly, aren't we, Chrissy? Other big matters on the agenda, the Munich Security Conference, the 60th of those security conferences taking place. We'll be having a conversation about all of this shortly. NATO has increased in size. Defence priorities have shifted in Europe as a result of the invasion of Ukraine, now nearly 2 years ago. And, of course, the Middle East violence playing out before us. So a lot to discuss when we head over to Munich. We're going to be speaking shortly to Rob Bauer, who's NATO's military committee chair and the most senior officer in NATO. We'll get his take on where the alliance stands, where its readiness is with war taking place on its very doorstep. We will get to that conversation shortly. This is Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. You are seeing some gains when you look at the broader stock 600. I mean, this is really kind of that momentum that continues from the futures market as well. You saw this over in the States as well. Now you're seeing that continue. But the question is just how much longer can the party go on? Because you are seeing earnings that really are, they're kind of meeting the expectations, but they're not surpassing them in a really big way. It seems like the buyback story perhaps keeping a lot of these stocks afloat. And as a result, the stock 600 higher by about 0.5%, Anna.
Yeah, absolutely. We're up around, as you say, 0.5%. The FTSE 100 up by 0.8% this morning. The CAC 40 up 0.7%. So it's pretty broad-based, isn't it? And we've been looking this morning to see whether we would take out recent highs, records on the stock 600. We are not all that far away from that. We had a number of this was an intraday high of 495.46, and I can see we're at 490.98. So we're not a million miles away from that. And it comes on the back of some very strong performance globally in stocks. We were talking to Mark Cudmore earlier on, Chrissy, about this, and he was saying, the dominant narrative just doesn't seem to be getting in the way of that positive story for risk assets right now. And we certainly see that continuing as we wait for Chinese investors to come back after the Lunar New Year holiday next week.
Yeah, and one of the big crucial pieces of that is, does the macro even matter right now? Because as you start to see rallies, either in the bond market or the stock market, the doomsdayers are going to come calling and say, how much longer can it really hold? And the momentum is quite crucial as well. There are a few individual stock movers we should talk about as well, because NatWest came out, Swiss Re came out, but there's one that's taking an extra little bit of a hit out of the market. This is Temenos, of course, a Swiss tech company that recently Hindenburg, the shorting shop, Hindenburg Research, has targeted. Now, they've done this before as well, last time talking about corporate governance issues, this time around talking about major accounting irregularities. You are seeing Temenos take quite the hit in this morning's market.
Okay, so that's where we are on that story. We've got Basic Resources doing the best. That's the best performing sector this morning. We'll keep an eye on the Temenos story, of course. But to the upside then, Chrissy, Rio Tinto, Anglo American, Glencore. And we noticed that iron ore prices were a little stronger through the Singapore session. You wonder, there seems to be some expectation, perhaps, building about what we'll see from China next week. So that's certainly something. And it goes hand in hand with strong risk appetite, doesn't it, buying up the Basic Resources sector. We had seen, of course, the NatWest share price a little weaker as a result of the numbers that we got got out earlier on, or the guidance really. Joe Easton telling us that some analysts have been seeing this as a sort of kitchen sinking of the bad news around NatWest, if there is some, as a result of their plans to come to market with a retail offering later in the year. So actually NatWest managing to turn around what was a loss on the back of that guidance to start with into a 3.3% gain this morning. So NatWest not doing too badly.
Not doing too badly. And then at the core of it, we're talking about these kind of more macroeconomic issues. We're talking about how much does the interest rate story eat into NatWest relative to some of the other European stories. Is it a positive for their net interest margin? Is it a negative for their net interest margin, as you point out? But then you have to talk about the geopolitics of it all as well. We're seeing, of course, the concerns on the Red Sea, the concerns in the commodity space as well. Does it then ultimately eat into the corporate space? And the bottom line for a lot of these corporate earnings is the European corporate story, the first kind of line of defense, for lack of a better term. Those geopolitical questions high on the docket at the 60th Munich Security Conference starting today. Key figures from government, industry, discussing the world's global security challenges. Of course, high on the agenda, the war in Ukraine and the strength of the NATO alliance after recent comments by former U.S. President Donald Trump. Joining us now for an exclusive conversation, I'm happy to say, Admiral Rob Bauer, chair of the NATO Military Committee. Admiral, a pleasure to have you on the program. We thank you so much for joining. Let's start there. It's been a wild week in terms of U.S. politics. As we just said, President Trump has made some pretty strong comments, even threatening to leave NATO altogether. In that scenario, who is best positioned within the alliance to step up?
Well, I think, good morning, Kriti. I think that what happens in NATO is important for the U.S. So I think in that sense, it is in the interest of all the allies, including the U.S., that the alliance is strong. It is strong at the moment, stronger than ever, actually. And we talked, the ministers of defense talked yesterday about, for example, the increase in the budgets and the fact that so many more nations now step up, deliver on the 2% pledge. It's now 18 nations out of the 31. So that is moving in the right direction. That is not money for NATO. The money that we're talking about here is money that nations invest in their own armed forces to make their own armed forces stronger so that they can defend themselves in accordance with Article 3 of the treaty. And I think that is all happening. We have great now plans in place. We're working on the executability of all that. It requires more people, more capabilities, more military training, and all that was discussed during the defense ministerial. There's a lot of work to be done, but I think NATO is in a great place at the moment, and therefore I'm not really concerned about this.
Well, Admiral, talk to us a little bit about that 2% pledge here. At the moment, the United States makes up over 2/3 of the military expenditures at the moment. Given the growing risks from Russia in particular, and perhaps others in the future, could you see that 2% pledge start to see any sort of pressure on the upside?
Well, the agreement in the Vilnius summit was a minimum of 2%. And actually, these discussions on the money is not on the money itself. This money is necessary for making these plans I was talking about executable. So to deliver on all the things that we need, as I said, more readier soldiers, more capabilities, more training, all that requires more money. And therefore, the discussion was on a minimum of 2%. And therefore, there is a recognition in the alliance that we might need more than the 2%. That's why the formulation was what it was. So if we need more money, as we see in a number of nations already, the nations are investing more in their armed forces. Poland is a good example, the Baltic states, of course, other nations as well. So that is why we see the ramping up in the funding, because the nations understand that they need to invest more in their armed forces.
Good morning to you, Admiral Bauer. So the European nations are stepping up, you say, and spending more on their own defence. And these comments that we hear coming from the US political campaign, of course, come at a time when you're trying to project an image of resilience and deterrence against Russia. How much do these comments complicate your ability to stand firm in the face of Russia?
I didn't hear your question completely because of the traffic behind me, but if you mean how ready is NATO, is that the question?
Yes, I was asking how much it complicates your ability to be strong in the face of Russia when we hear comments such as those made by former President Trump.
Well, the unity in our alliance is one of our biggest strengths. The fact that we stand for each other, with each other in the face of an adversary, and I think that is extremely important. We've shown that when the war the full invasion in Ukraine happened. Within an hour, the North Atlantic Council had an agreement on the things we had to do. It was not just a statement. 40,000 troops came under command of the Supreme Allied Commander Europe. Airplanes, hundreds of airplanes were in the air, hundreds of ships were at sea under command of NATO. And that in itself was an enormously powerful message for Russia to make sure that they understood that NATO will respond when we are seeing that threat rise. And I think that is what we did as an alliance. So I think the fact that we did what we are here for is actually the reassurance you are talking about.
Admiral, the money matters, of course, and then there's what you're able to do with it and produce with it. Do you think we need to see more incentives for more military production to take place within Europe?
Absolutely. Across the alliance, in the US, in Canada, and in Europe. We need to increase defense production to a great extent. We see that the Russian production in the Russian defense industry is being ramped up much faster than all of us held possible. The economy in Russia has turned into a war economy. What we need to do is to make sure that we are able to continue to support Ukraine for as long as it takes, with whatever it takes. And then the second thing is we need the capabilities and the ammunition for ourselves as well to be more ready. So what we have seen is a longer discussion in Europe on not only are we going to do this, but also convincing financial institutions to invest in defense. This is the liberal economies that we are living in. So this is about convincing the investors to make sure that all the regulations are in place to build a new factory. So there's now some good examples in Germany where a new Patriot factory is going to be set up. There's a new factory for artillery ammunition in Germany, in Denmark, in Finland. So things are happening. It took a while, and we need to continue doing that, ramping up the industrial production, convincing the financial sector it is ethical to invest in defense.
Well, speaking of Ukraine and particularly in the support there, Admiral, I'm curious about how you're assessing their progress on the battlefield and where else outside of Ukraine you may see the risk spilling over to from Russia. Give us a little bit of a status update if you can.
We don't see a direct spillover in terms of a conflict with other nations or with NATO. It is very difficult at the front line in Ukraine. The new commander of the armed forces in Ukraine, General Syrskyi, said so himself yesterday. The front is heavy fighting. It's amazing how many lives the Russians basically accept in this battle. As I said, the Russian defense industry is ramped up, so the Russians have more artillery ammunition at the moment, which they are using heavily. They are using a lot of soldiers that are being killed in large numbers. It's amazing. So it is a difficult time for the Ukrainians, and therefore it is extremely important we continue to support them with everything that they need, and for as long as it takes. So that is what we need to do. And I think if you would have asked in the Second World War after 2 years on a number of allies, how are things going? Then at that time it was difficult as well. So we didn't start to support Ukraine because it was going to be easy, but because it is necessary.
Admiral, you're talking about Russia's growing defense capabilities as well. Just in the last 24, 48 hours of the United States, there's been talk about Russia's military capabilities in space, potentially targeting satellites as well. NATO has come out and said that 50% of the satellites around the world are owned by NATO allies. It helps with things like missile detection. I don't need to tell you this. How seriously are you taking that threat? Have you been briefed on it? What is NATO's line?
NATO will look into every threat that we're facing, 360 degrees, that is on land, at sea, in the air, in cyber, and so also in space. And that's everything. I'm not going to speculate on this. So we are looking at this, of course, as we are looking at all the other threats that are around us.
Admiral Bauer, thanks very much for joining us. Rob Bauer, NATO's chair of the Military Committee. Coming up on this programme, we will get back to some of the corporate earnings stories and some of the other global threats we deal with around climate change could make their way onto the agenda as we talk to the Swiss Re management. Swiss Re reports a surge in net income, but the insurer receives a mixed reception from analysts and investors. We'll talk next to the CEO. This is Bloomberg.
Ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
TradeMasters markets today. We're 46 minutes into our European trading day, and European stocks are moving higher. The Stock 600 up by 0.5%. The FTSE 100 up by 0.7%. Basic resource stocks make gains. The Swiss Re share price under a little bit of pressure this morning, down 1.5%. Swiss Re has reported a surge in full-year net income, driven by higher underwriting margins and interest rates. The profit was in line with estimates, with the reinsurer's return on equity coming in slightly below consensus. Swiss Re's shares trading lower, as I mentioned this morning. Let's talk to Christian Mumenthaler, who is the Group CEO of Swiss Re. Christian, nice to have you with us, so thanks for joining us. If we could delve straight into the numbers that you've reported here. I note some analysts asking questions about the reserve charge that you've taken, wanting to get some clarity on the nature of the reserve charge to sort of allay some fears. What can you tell us about that?
Yeah, thank you for having me. So first of all, of course, we are happy to have achieved all of our financial targets because this is our first priority. And we come through a phase where we had to deal with a lot of challenges like COVID, a war, inflation, et cetera, et cetera. And so this is a bit of a turning point to be able to do that. And then our second priority for now and going forward is to make sure that we lower the cost of equity by having less volatile results, by being more cautious, et cetera, et cetera. So these are the two main, priorities, and we have done a lot of progress on both of them. So I wouldn't look too much. My experience is the market needs 2-3 days to get to grips with the results. We need to have the discussions with analysts, et cetera. So overall, I'm really happy with where we are, and I'm extremely positive about the outlook.
Okay. Can you tell us any more then about what the reserve charge is, what constitutes it, and what you expect from the P&C unit for the rest of the year?
Yeah, so this is about this so-called social inflation in the U.S. So the price of casualty, the claims have gone up 16% every year for 5 years, which is massive, and has to do with this whole litigation system, funding by hedge funds, et cetera, that exists in the US, and has picked up back after COVID. There was a court closure in COVID, has picked up back up, and so we had put reserves throughout the year to compensate for some of these losses that we've been seeing, and try to go ahead of the curve if possible on all of that, which is called the IBNR, incurred but not reported. So we put quite a bit into that. We could compensate these reserve increases by releases in other lines. So it's basically there's a story of two tales. There's very positive releases on some of the short tail line and some strong strengthening of reserves on the casualty lines in the US in particular.
Christian, it's Credy in London. Good morning. Let's talk a little bit about the balance between that traditional reinsurance business and the government. You're talking a lot about the United States and perhaps the regulatory and litigation pressures there, but do you see the balance kind of swinging back in the next 12 months or so?
You mean balance in terms of how much the states would insure and reinsure and protect versus what the open market is protecting?
Correct.
Yeah, so I think there is a way to think through. I mean, the insurance and reinsurance industry is very strong at diversifying risks at the global level. I think it's a system that works extremely well, but has its limits. The limits are when there are risks that are huge and not diversifiable. So a big pandemic, for example, or huge cyber incident, or whatever, a nuclear attack, or things like that. There's risks that are not ideal. But for all the other risks, I think the insurance and reinsurance industry is very well adapted to take these risks. And what people usually forget, very good at distributing the claims once the event happens. So it's not enough just to have the money, but you also need a mechanism that when the event has happened, you can basically distribute to the people who need it. And that's where the insurance industry really has an advantage over any type of government scheme. So I would argue for a rational dialogue around where government intervention makes sense, which to me is for TRIPA, so the terrorist, for example, the terrorist pool in the US, that makes complete sense, and other places where the private industry could cover the risks well.
Are there places in the world outside of the United States, for example, that aren't insurable at all? Just given kind of the laundry list of concerns that you just laid out, where would you not provide that insurance?
Yeah, I think on the natural catastrophe side, where this argument comes up, there's no place I'm aware of where we wouldn't be able to cover it. There might be some, micro regions. Let's assume we have a floodplain, for example, that now through climate change gets flooded every year. That's not insurable because it makes no sense. It's an event that happens all the time. But I think the concern is more an economic concern as prices rise, because the events are more frequent. So technically you can insure them. They're not uninsurable, but it's a question of affordability. And if you think about this whole system, one of the roles that insurance and reinsurance provide is to give a price to risk. So to a certain extent, this is the first time that the cost of climate change is coming back to the consumer. It was an abstract concept before. Now we can see through the statistics and what happened through the last years, it's real. And so this becomes real cost that comes into the system, and of course generates all kinds of negative reactions. But it's a signal that we should take seriously because it's a signal of the actual risk costs.
Christian, so do you think there is no such thing then as the uninsurable world? Is it just a matter of how much people are prepared to pay, the true cost of that insurance?
I think where I would get worried is in specific locations where people build their houses in the wrong place, and where, for example, the free market of insurance, reinsurance is not allowed, so that you have no pricing signal that will prevent you from constructing, and then you start to construct, you have lots of construction at the wrong place, and if the event becomes very frequent, while technically it's insurable, it makes no sense. It's not affordable anymore. So I think the affordability topic is certainly, more than the insurability topic, is one that we're going to see increase, in particular, I think, for flood, maybe also for fires, etc., across the world.
Okay, so affordability rather than insurability is interesting. Now, as insurers, of course, you manage a lot of money, Christian, and as reinsurers, you manage a lot of money. Can you talk to me about the trend that we've seen for insurers putting more and more of their assets into things that look a little less liquid? So I'm thinking here about real estate and other alternative assets. Where has that left Swiss Re?
Yeah, so of course we learned our lessons from the financial crisis. So we have had a very straightforward portfolio since then, lots of liquidity on the government bond sides, still a lot of that, and then very high quality credit, and a limited amount, about 15% of the portfolio that can be in illiquids. And if you think about the structure of our balance sheet, there's of course all the liabilities we have vis-a-vis our clients, where we have a matched approach. So we have bonds that match the duration, and then we have our own equity where we can afford, for some of the very long duration, to have some part in the liquids. But this is something we look very closely and we're not very exposed to. And real estate is a small part of that, very small part.
All right, Christian Mumenthaler, Group CEO of Swiss Re. We thank you so much for joining us this morning. Anna, he ended on a topic that I want to say is one of your favorites, which is the real estate exposure, which is interesting. Just in the last 5 days, the dynamic and the conversation around the commercial real estate risk has kind of disappeared.
Right, yeah, it's not quite as loud as it was, perhaps, but maybe it's just still bubbling there under the surface. I think it's interesting. For the second day in a row, we asked about commercial real estate, and a senior executive tells us, in this case, the CEO of Swiss Re, we learned our lessons from the GFC, and we heard exactly those words yesterday in a different industry, but from Commerzbank, wasn't it? So interesting to get that sort of take. You're still dealing with a management cadre that perhaps still shows the scars of the post-GFC era or the run-up to the GFC era and the exposures that were gathered there.
It brings it back almost full circle. If we're learning a recession, learning kind of a lesson from every recession, if GFC was about commercial real estate, and then perhaps QE off the back of that, was the 2020 recession all about supply chain resiliency? And was that then now coming back? Has a lot of corporate Europe and corporate America learned their lessons from that as well? How many more lessons are there to learn, Anna?
Well, we are always notoriously preparing for the last crisis rather than the one that's still to come, aren't we? But with pandemics, you do get the sense that any preparedness, it's not going to go to waste. Let's just quickly check on the markets, shall we? We've got the Stock 600 up by 0.5%. The basic resources sector doing the best there, as we made the point earlier on. It's pretty risk on out there, isn't it, for stocks? And we see basic resources stocks up by 1.6%. The stronger iron ore price helping there. And it's a pretty defensive bunch to the downside. Utilities, telecoms, food, beverage and tobacco.
And your biggest weight, by the way, on the Stock 600 is still coming back to that Temenos story. Really, Hindenburg Research doubling down on their concerns, more about the corporate suite governance, but also about the accounting pressures as well. Those shares down just shy of about 6%. That does it for markets today. The Pulse is up next. There's a ton going on. We're going to talk about these markets. We're going to talk about some of the really important guests, not to mention the geopolitics that we are seeing revisited around the Middle East, Ukraine, Russia, and of course, central at the Munich Security Conference. Stick with us, plenty more ahead. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The Atlanta Fed President Raphael Bostic pushes back on rate cuts amid mixed U.S. data. Markets await U.S. producer prices due later today. Another blow for the UK Prime Minister Rishi Sunak as the ruling Conservative Party suffers two heavy by-election losses. There's some positive news on the economic front as retail sales rise the most since 2021. Plus, the wars in Gaza and Ukraine and the fallout from Donald Trump's NATO remarks are set to dominate the agenda as world leaders meet in Germany. Now, we'll be speaking to the Ukraine's Deputy Prime Minister for European Integration at the Munich Security Conference. We'll also have an exclusive conversation with the Greek Prime Minister's Chief Economic Advisor. Both of those are coming up shortly. But first, as always, looking at the European markets map. So this is a picture across the board. Now, stocks broadly higher. A lot of news to digest on what various Fed officials have talked about. Again, the risk-on mood seems to be prevailing after a little bit of a wonky week overall for some of these markets. It does follow, of course, another record on Wall Street and also some encouraging Chinese consumption data. I would argue that the data point of the day we don't often talk about is PPI over in the U.S. And again, that will give us an indication, or investors want to know what that means for the economy and therefore the probability of Fed cuts. Now, to talk about these markets, we're now joined by Sonia Martin, head of FX and monetary policy at DZ Bank, who joins us now. Sonia, thank you so much for joining us. We're also joined, of course, by Justina Lee. Always great, Justina, especially on a Friday, actually, to see exactly what's going on with the markets. And then we'll get to Sonia in a second. Justina, when you look at some of the things that the market is latching onto, again, it's inflation, it's Fed speak. Is it now almost a done deal because we heard from ECB really trying to push the message that we could even see a March cut, or certainly from some officials that we get ECB cutting before the Fed?
Yeah, that would certainly be a big deal. And it's kind of evident if you look at the currency trends lately, right? Because I think going into 2024, everyone thought, this is the end of the reign of the U.S. dollar. But lately, we have seen the U.S. dollar kind of pick up a little bit versus other currencies. And I think one reason is sort of this shift in their narrative. I mean, a lot of people are glomming onto, for instance, like what Fed official Bostic kind of said overnight and kind of what the U.S. data on CPI is showing. And they're kind of thinking, is the order going to be different from what we previously expected?
Yeah, and Justina, let's listen to what Raphael Bostic had to say.
We will likely soon contemplate the appropriate time for monetary policy to become less restrictive. Right now, a strong labor market and macroeconomy offer the chance to execute these policy decisions without oppressive urgency. Put simply, we have made substantial and gratifying progress in slowing the pace of inflation. All things considered, the U.S. economy is in a good spot, even an enviable spot compared to other major economies.
Sonia, thank you for joining us. Sonia Martin there from DZ Bank. Nice pink as well for a Friday. Sonia, what do you make of now, market expectations of how many cuts we'll get from the Fed?
Well, we've obviously seen a lot of volatility in those expectations, and the markets really, really ran ahead of themselves, late last year with these really aggressive rate cut expectations. They have been scaled down, and I think that's correct. I mean, we've long held the view that the Fed will not be able to cut as much as the market is expecting. We have 75 basis points on the agenda for this year, so that's still less than the market is expecting right now. And as Bostic said, the economy is still very strong. The labor market is strong. And inflation, while it has come off a long way, is still too high. So the Fed needs to be careful. It can't cut too early. It needs to cut because the real policy rate has risen because of the decline in inflation, but it is going to be in a rush. So we're looking at the summer, probably June for a first rate cut.
So, Sonia, what does that mean in terms of, again, we are also seeing a lot of productivity gains when it comes to the U.S. economy. Is this economy going to be much, much stronger than we're expecting it to be?
I think it already is a lot stronger than everyone was expecting it to be. I mean, we've been facing the slowdown, even at times a recession for a long time now, and it's clearly not happening. So I think we've already reached this point where I think those expectations for a significant slowdown have been priced out of the market. Some people are talking about no landing, but at the very least, we're looking at only a very moderate decline in growth. So the U.S. has defeated all expectations. It's sustained, high interest rates without too much damage. And so, we're probably already at this point where the market has priced that in. I mean, I don't really see how much more upside surprises we can actually get here.
What does that mean, Justina, on how, again, you look at the markets and actually what it means for treasuries?
Yeah, it's kind of interesting because today we had a headline saying that a fund manager at Jupiter is actually going to buy treasuries because they still see a hard landing. And I think today I also saw a Jeffrey strategist was like, this is actually an attractive point to start holding treasuries. And I think maybe for some investors, if you have a long enough perspective, I mean, with rate cuts still on the table, this is a good time to start buying. But of course, if you kind of on the shorter end, we've got to weigh that against much broader inflation than investors previously expected.
Yeah, and to Justina's very good point, Sonia, are there parts of the market that actually seem unloved at the moment, even commercial real estate, that will be, very loved if interest rates go down as much as expected? So this is a good buying opportunity.
Well, I certainly think we're very much still in a sort of very friendly market environment, and that's unlikely to change. I mean, you're looking at rate cuts, maybe not as much as people thought, but we're still looking at rate cuts. That's got to be good for the equity market. We're looking at very robust growth in the US. We're looking at a mild recovery in Germany, in Europe as a whole. So I think it's still a very friendly overall market environment. But there are, of course, certain risk factors in the equation. We're all trying to figure out, geopolitics, U.S. elections, all of those things. So I think we're still looking at a year with considerable volatility, just because there are so many question marks in the mix right now, and investors are going to remain, I think, very event and data-driven in that environment.
Sonia, what does that mean for your call on U.S. dollar, and what does that mean actually for some of your favorite pairing? I know you've been looking at, for example, dollar-yen.
Looking at the dollar, I mean, euro dollar specifically, we now have a fairly flat forecast around 108, which always looks a bit boring, I know. But fact of the matter is we're going to get a pretty wild mix of influence factors. The recovery in the Eurozone, the still very strong U.S. economy with little surprise potential to the upside, I think. So we're probably going to see quite a volatile trading range, but I see in euro dollar certainly no clear trends. When you're looking at dollar yen, it's more interesting because we still have the BOJ in the mix, but they hope that they will at some point, move away from its ultra-expansionary stance, and that should definitely boost the yen. So the dollar-yen downside is still very attractive.
Justina, again, it feels like the PPI, which is, I don't know if we largely ignore it, but it's not one of the data points that we look at the most today will be quite significant, Justina.
Right, exactly. And based on what economists are expecting, they do see a bit of a pickup on a month-on-month basis, but kind of the year-on-year trend still showing kind of inflation gradually cooling. And I think what was really notable, and which is why people are paying so much attention to this PPI number, is that from what we saw earlier this week, I mean, US CPI, it's not just about one category or two categories. I mean, it really showed a pickup, especially in terms of rent, in terms of housing costs. And I think so people are definitely kind of looking for signs that the U.S. economy might even be reaccelerating despite sort of the lagged effects of monetary policy supposedly coming through.
And Sonia, I know I have quite a lot of viewers that are actually sending me charts on productivity in the U.S., which is phenomenal. After 2-3 years of stagnation, it's really picking up. I mean, could that be the next boost to really drive the U.S. economy?
Well, yeah, I mean, the surprise in productivity, the increase in productivity has come, I think, as a bit of a surprise. And there's, of course, a lot of discussions around where that's coming from. One factor probably has been the tightness of the labor market, which has, driven probably efficiency in processes. That's probably given a boost to productivity. But yeah, it's one more factor which is driving a very strong U.S. economy and is preventing, a slowdown. Although obviously there are pockets of, well, I'm not going to say weakness, but there are certainly pockets of concern. But overall, it's just really, really strong. Consumption remains strong. There is really no sign of a serious let up, and I can understand investors that are still concerned. I mean, there's a fear, I think, that people have held on to a slowdown story for a very long time and are kind of scared to throw it overboard at the last, at the worst possible moment. But yeah, I mean, the U.S. is looking very solid, no question about it.
Sonia, thanks so much. Sonia Martin there, head of FX and monetary policy at DZ Bank, and our very own Justina Lee. Now, coming up, the UK Labour Party has taken 2 seats from Rishi Sunak's Conservatives. How will the Prime Minister regain momentum after this double election blow? Will he? We'll discuss that next. And this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back. Now here in the UK, Keir Starmer's opposition Labour Party has overturned significant Conservative majorities to win 2 parliamentary by-elections. Now Labour continues to lead in the national polls, and this morning's results further dent Rishi Sunak's hopes of regaining momentum after this year's general election. Now, to discuss all of this, we're joined by Bloomberg's Adam Blenford. Adam, thank you so much for joining us. I mean, this was, pretty extraordinary result. Does this translate into the general election?
It's always difficult to translate a local result where there's been specific opportunity for thumbing your nose at the government to a general election. But it's very true that Labour has won a series of these by-elections now over the course of the recent Parliament, and these were really striking results. The second biggest swing to Labour in the post-war general by-elections. 28.5% in Wellingborough, and very large Tory majorities were overturned and wiped out just in the space of one night. So marry that with opinion polls nationally, which have wobbled a little recently, but generally have been very much in favour of Labour for a long time now. And it's an election has to be held very soon. And it will be very difficult for the Conservatives to overturn this kind of momentum.
So all parties will now be back home kind of strategizing on what this by-election means for, the elections. Will they be in the spring or in the autumn? That's another question. What about Reform UK? So this is basically the far-right party in the UK.
They've come out of what used to be the Brexit Party.
Yeah.
They were formerly led by Nigel Farage, and they had a significant impact on the last election when Boris Johnson won a big majority because they decided not to run in quite a lot of seats. What they did last night was they took a lot of the Conservative support. Labour increased its gain by something around 10% in both of these seats. Reform did the same, and the Conservatives lost around 20 or thereabouts. So there'll be a significant factor if they choose to run on a platform of anti-immigration, anti-European, and general dissatisfaction with the way that Sunak has run the Conservative government.
So they're basically splitting up the Tory party, right? They're kind of to the right wing of the Tory party.
That's certainly what they say. There may very well be some disaffected Labour voters who went to Brexit Party voters in the past, but in general, Reform seem to think they have a lock on kind of the right wing of the Conservative electorate.
Adam, thank you so much. Adam Blenford there with the very latest on UK politics. Coming up, the AI race is heating up between big tech with new developments from Apple and OpenAI. We discuss all of this with Michael Fertig, founder of Silicon Valley VC firm Heroic Ventures. That's next, and this is Bloomberg.
there is no digital without chips. And I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Now, Bloomberg has learned that Apple is nearing the completion of a new AI software tool for app developers. Sources say it will predict and complete blocks of code. Now, the move sees the firm stepping up its competition with Microsoft. Meanwhile, OpenAI, which has a multi-billion-dollar partnership with Microsoft, has also teased a new system that can create realistic-looking videos based on text prompts from users. Now, the company's chief executive, Sam Altman, says the AI tool called Sora can quickly create videos up to a minute long, making it the latest company to embrace generative video technology. Now let's discuss all of this, some of the AI headlines with Michael Fertig, founder of Silicon Valley VC firm Heroic Ventures, credited with pioneering the field of online reputation management. There's so much going on, Michael. I'm so happy to have you here. When you look at AI and when you look at, NVIDIA really going from strength to strength, we know that the City of London is like, why did we not get that ARM, listing? Right. Because also valuations were quite incredible. Right. Is the sky the limit?
I think the sky's the limit. Look, I don't comment on public stocks. I'm not a professional public stock investor. I do hold NVIDIA in all of these stocks, like most of your viewers probably. I do think the sky's the limit. This is the third time in my career, I'm now 45, where I think I've seen something that is going to have a before and after epochal change. So internet, CRISPR, and now AI. I think that the AI movement will have at least as big an economic GDP impact as the internet has, maybe greater. Yeah. And so does that translate into an ever-growing stock price? That I can't say. No. But I'm bullish on it. I'm also bullish on private companies. I've invested in private competitors, emerging competitors to the NVIDIAs of the world, because these machines are hungry. And the LLMs and the models are hungry. They have enormous computing power. So I do think that the demand for the chips will be increasing.
But, Michael, there's something, quite strange, but also that people are quite excited about in the U.S. economy, which is productivity is suddenly going up. Is this because of the tools that we're using? And I don't know where you would qualify as being. Is it just pre-AI dominance? Like, how are chief executives using AI?
Well, revolution like this usually takes a little bit longer and then goes faster.
What, then 2 months?
Okay, fair, could be. I tell you, I've been doing tech since I'm 19. I'm now 45. Every 2 weeks I wake up and say, oh my goodness, something has changed. I will say that I don't know if the productivity is attributable on a GDP scale to AI yet. I do think in the software businesses, your kind of early stage junior developers are basically now being replaced by AI. The bottom 20%, the most junior 20%. Whether this has yet put its tendrils into the global economy or the software economy globally yet, I think it's premature to say, but it is coming. It's coming in video, it's coming in healthcare, it's coming in software, it's coming in trading. Oh my goodness, do you think that Lyft roller coaster was done by humans a few days ago when the stock price roller coaster?
So what are you focusing on, productivity or job losses?
I'm focusing on growth. I always focus on growth. So productivity is going to be always the driver of all revenue. As an investor, I would like to look for companies that can
give the CFO, the CEO, the CMO more revenue. There are about 20% of successful companies that look to save the company money. I think those are less exciting to me. Yeah. I'm always looking for companies that can make the company wealthier, that create more shareholder value through gains. Larger revenue leads to larger margins, but not sort of margin compression through savings. Although I will say, you are seeing now the biggest companies in the world, like Apple, as you say, assist their economies in bringing more app developers, more of their ecosystem onto their platform using AI, and whether that entails software development, software code completion, or something else like just, hey, we'll make your onboarding easier. Yeah. All of it's going to go to gains to companies like Apple.
But Michael, so if you look at, for example, Apple, and I know you don't comment on individual stocks, especially the ones that are listed, yeah. But if you look at the valuation now, does it double from here or otherwise lose it? Like a lot of these big AI companies, do they have to get much bigger and much stronger in terms of growth or otherwise lose everything?
Here's how I can answer that question. A lot of the AI game right now is turning into a little bit like the search game of 10 or 20 years ago. The search game turns out to be a hardware game. You need a lot of memory, a lot of data in state so as to be able to deliver search results in femtoseconds, right? And so in the same sense, if you have an enormous balance sheet and can afford these very expensive computers and thousands of them, you have a structural advantage. It's very hard for startups, even well-capitalized startups, to compete with that because you need all this hardware that's money for CapEx. Right. And therefore, I think a lot of the gains will go to the big companies that are already large.
What's that CapEx doing? So again, our Bloomberg sources say, for example, that Apple is looking at, to rival Microsoft to give the better tools to do coding for you. Like, what's the next frontier?
Well, you asked the key questions. What is the CapEx doing? It's buying enormous server farms. Enormous. And by the way, these NVIDIA chips
That's not private equity. Aren't they buying them?
well, by the way, what just happened is Salesforce, I believe, if I'm not mistaken, just announced an investment in a company that is effectively reselling access to these server farms for NVIDIA chips because they're so scarce, they're so expensive, and you need so many of them to power these enormous models that the balance sheet heavy companies, these rich, enormously cash-rich companies, have an advantage to buy them, deploy them, and create speed that no startup can replicate.
But, Michael, is this infrastructure? And again, it's clear, like, we need a new ecosystem, right, if AI is really going to take off. So do you play it through the AI players, or is it actually just infrastructure and maybe renewables or greening the technology?
As usual, you're 2 steps ahead of the market, Francine. You're exactly right. So the big structural companies will have the hardware, but then the ecosystem of applications, of frameworks, of layers on top of those LLMs, those models, those infrastructures, that's where the gains will come for the startup ecosystem, for companies that are not already enormous software giants and hardware giants. That's where I think much of the trillions of dollars of wealth creation will actually come. You're exactly right.
Michael, I know the UK, in an election year, is basically trying to pitch itself for the current administration as, the frontier of AI, the frontier of technology. They want to be the next NASDAQ. I mean, can they do it, or is it going to be France and others that will be quicker?
No, the UK will not be the next NASDAQ of AI. But I do think Rishi Sunak is trying to pitch the UK as a place where AI can flourish. And so far, I think there's a good case that AI can flourish in the UK. The EU is already passing legislation which could actually strangle innovation in the AI
if you do
field.
It too fast.
And in fact, I think that legislation will become law, I predict, this summer. So the UK is actually playing a little bit more of a libertarian game. So there is reason to believe that these progressive corporates in the UK, these very powerful multinationals headquartered here, with a libertarian regulatory outlook, could allow AI to flourish in the UK. But is it going to become the NASDAQ of AI? No. I'll just end that discussion here. No, it will not become.
Why? Because of capital attraction?
Because it's a very small country relative to the countries like the United States and China that have all the capital to make that capital investment necessary.
We need to talk China. You need to come back so we talk China.
I'm ready to talk China.
There you go.
Ready to come back. Anytime for you, anything for you, Francine.
Michael, thank you so much, as always. Michael Furtick there of Heroic Ventures. Now, coming up, we're live at the Munich Security Conference. The Ukrainian Deputy Prime Minister for European Integration. That's coming up shortly, and this is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Well, the Atlanta Fed President, Raphael Bostic, pushes back on rate cuts amid mixed U.S. data. Markets await U.S. producer prices due later today. Another blow for the U.K. Prime Minister, Rishi Sunak, as a ruling Conservative Party suffers 2 heavy by-election losses. But there's some positive news on the economic front as retail sales rise the most since 2021. Plus, the wars in Gaza and Ukraine and the fallout from Donald Trump's NATO remarks are set to dominate the agenda as world leaders meet in Germany. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Ukrainian President, Volodymyr Zelensky, is set to meet the German Chancellor, Olaf Scholz, later this morning in Berlin. He then heads to France, where Zelensky is expected to sign a bilateral security deal with the French President, Emmanuel Macron. Now, it comes as Ukraine struggles with ammunition shortages and U.S. military aid is delayed on Capitol Hill. All of this high on the agenda this weekend's Munich Security Conference, which President Zelensky is expected to attend over the weekend. Now, for more on all of this, we're joined by Roz Matheson, Bloomberg's EMEA News Director. There is a lot going on, Roz. When you look at world leaders actually convening in Munich, what will be front of mind?
Well, obviously, Ukraine is going to be front of mind for all the reasons you were just saying. You know, Ukraine struggling on the ground to push back Russia, shortages of weapons, shortages of financial aid, all of that's being held up in various places, including the US, and not really getting a lot of traction, you know, in the calls for support. And that's why it's going to be interesting to see the Ukrainian President Zelensky, if he's there, how his conversations go. Of course, some of his most recent appearances, including at UNGA, weren't particularly successful. So is he able to rally there and get more support that he says is needed? But in a way, Munich will be about some of the things that are really out of control of the leaders right now. And first and foremost, that's going to be what kind of government are we going to have in the US after the election in November?
But so if there is a funding gap, you know, that the U.S. doesn't put as much money as they said they would, can Europe actually step up to help Ukraine?
Well, Europe is stepping up, arguably. They are increasing the aid to Ukraine. They're increasing their own defence spending also to kind of ward off those criticisms by Donald Trump about how much they're contributing towards NATO and collective defence in Europe. But the question is, how quickly can that aid get there and how much is needed versus what Europe can supply? And certainly we know even now Europe's not managed to meet its pledges on ammunition. It's promised certain amounts of ammo to get to Ukraine. It's not met those promises, existing promises, let alone own future promises. So even if they pledge further aid, there's going to be a gap in that arriving.
How will the Munich Security Conference actually address Israel and Gaza?
Well, that's the other big question in the room, obviously, for leaders and other officials who are meeting there. You're seeing this pressure on Israel from Europe, from the US, increasingly yet another phone conversation between Joe Biden and Benjamin Netanyahu, where Joe Biden is saying, please don't do a ground offensive into Rafah in that area near the Egyptian border against the Palestinians there, unless you've got a proper plan for the security of civilians who are there. And yet Israel seems determined either way to go ahead. So what are we going to see in terms of meetings in Munich to kind of push that message again collectively, that warning to Israel? But will it have any effect? So far it just seems that Netanyahu is determined either way.
But Raz, what would have an effect? I mean, could the US actually turn around and say, look, we're stopping funding and support if you don't take care of civilian casualties?
Well, that would be a very big move by the US, because they are a strategic military and trade ally with the US, with Israel rather. But also for Joe Biden, there's got to be the calculations again of an election year. Do you want to be really doing that to Israel when he's also got to think about, you know, the voting base at home in the US, including Jewish voters?
Yeah. Roz, very quickly on Ukraine, and we have actually the Ukraine Deputy Prime Minister, I think, who's joining us very shortly. But is there a danger that as the world focuses so much on, you know, the Middle East and that part of the world, that Ukraine is forgotten?
Well, that's certainly even something that Zelensky himself has noticed and talked about in recent months, is that, you know, obviously, you know, Ukraine expresses solidarity with what's been happening in the Middle East and with Israel after that Hamas attack. But even he said it's sort of like, it's awkward, because does it take away the focus and attention from Ukraine? That's got to be an absolute reality.
Roz, thank you so much. Let's also bring in Ola Stefanishina, Ukraine's Deputy Prime Minister for European Integration. She joins us now from the Munich Security Conference. Deputy PM, thank you so much for joining us. Your president, President Zelensky, is actually signing a bilateral security agreement today with France and Germany. Is that now a more pressing path forward rather than EU or even NATO membership?
Well, it's an inevitable element of shielding some military and financial support to Ukraine and advancing military and industrial cooperation and production, making sure that Ukraine is capable to defend itself and Europe is capable to defend itself for as long as it takes in practice. So it's vital. At the same time, these are the arrangements which form the bilateral basis for security and defense cooperation, shape up the legal commitment on support to Ukraine's territorial integrity and sovereignty, but also are operational until Ukraine becomes a member of NATO. So we're having a discussion here, and President Zelensky have already arrived to Berlin, and hopefully more good news to follow.
So the EU agreed to open, you know, membership talks back in December. I know there's also a financial aid package that was passed earlier this month. What do you see as your 2-3 priorities actually going forward?
Well, it was a very important decision to us, and basically European process and Ukraine's membership to EU is the major guideline and the mapping of the democratic reforms. It's a very important transformations that we are putting to our focus, reforms related to the rule of law, democratic freedoms, democratic institutions is the core of our existence. While we're fighting the war, it's very, very important that we make and keep the country being fully functional, operational, and democratic. So that's the core of our accession process to EU, and that's how we work. In fact, Ukrainian delegation will head over to Brussels already this week for the first round of negotiations on the rule of law.
There's a recent German research group that actually put out a report only today saying that the EU would probably need to double military aid if the U.S. gap or if the U.S. assistance for Ukraine remains stalled. Have you had any assurance, or do you think that the EU would be able to provide that assistance? And is there a political will and the money?
Well, decades and the years of fatigue and basically misbelief that the full-scale war could take place at the heart of Europe has led to the situation where it would take a bit more time to enhance or reinvent the defense policy at the European continent, to understand that protecting the values, you have to have the weapons, the military, the army, and the war in Ukraine has really make it very brightly seen. So I am sure and confident that Germany, European Union, together with other allies and partners across Europe, will make sure that Europe is capable to defend itself. And the gap analysis has been done. The decisions will be taken like EU defense strategy, EU common defense industrial policy. But for the major thing for Ukraine is to withstand throughout this period and make sure that we curve our victory and make sure that Europe will be able to preserve it.
How concerned are you about the delays in U.S. support, and is that likely to get better or worse under a potential Trump presidency?
We have this slight movement in terms of the decision, and now when Congress has went to a break until the beginning of March, we have still a slight hope. But of course, we cannot ignore the fact that it's already for almost 3 or 4 months. Ukraine does not have any decision on support, and it already forms a gap in our ability to cover the liquidity in the budget and also the forecast and plan for the military support. So the problems are taking place and occurring already right now. We have the hope. We are working on the different B and C plans. We do the contingency planning on our side, but at the same time, we see a lot of politics and political rhetorics related to elections in this discourse. So we hope that our hope is based on the understanding that politics is politics, but the sovereign interest of the United States to preserve the democracy around the globe will prevail on both sides.
Thank you so much for joining us. Olga Stefanishina, they're Ukraine's Deputy Prime Minister for European Integration. Now, still with us, Bloomberg's Ross Matheson. And Ross, I know President Zelensky has also said that actually this year will be very decisive. I mean, again, and we heard from the Deputy Prime Minister for EU Integration about maybe some of the timelines that they're working at. But also on the ground, it's not necessarily going the way they want it to go.
Well, certainly that's right. You could see there from the comments, obviously, a strong awareness of the timeline and as it gets further into the US election cycle. But also we've got European Union elections in June, and that's going to come into some of the rhetoric that you might see in Europe, because it's not just in the US that you are seeing some of those conversations about where is this war going. We are entering the 3rd year very soon. It's very bogged down on the ground. Russia is starting perhaps to make some further advances again because Ukraine is quite clearly struggling for ammunition and weapons. And so is the war starting to go on the ground at least? I mean, Ukraine's had success sinking Russian ships, which has to be noted. But, you know, in territory, it looks like Russia might be not far off some fairly strategic moves there, and that would really set back things for Ukraine.
Ross, we also heard from, the president of Russia, Vladimir Putin, saying that, I mean, he gave 2 big interviews, and I don't know whether he's feeling emboldened or he actually waited on the U.S. election, but it's a little bit nuanced. It's unclear, actually, who he wants to win the presidential election, or whether we care.
Well, that's right. It was interesting to see those comments. I mean, obviously, he's coming into his own election very soon, where there doesn't seem to be any element of doubt that Vladimir Putin's going to win that election and be ready for another term. And so is he feeling fairly confident about that? He's managed to really squash any opposition, political or otherwise, at home to himself. And so he can play the longer game, potentially, at this point. He can look through some of the election cycles elsewhere in the US because he's locked in for another term. And he made some comments about Joe Biden, where he called him reliable, predictable, old style. And on the surface of it, that sounds like he says, well, Biden is someone I can deal with and I would prefer as president. But is that because he thinks that Joe Biden is an equal partner, or someone using those words again, predictable, understandable, old style politician, someone he thinks that he can actually get his way with? So perhaps it wasn't really an overt compliment of Joe Biden.
So interesting, Ross. Thank you so much, as always. Ross Matheson, our EMEA News Director. Coming up, Greece has approved landmark legalization, of course, of same-sex marriage. Well, we'll discuss that and the latest on the nation's economy with the Greek Prime Minister's chief economic advisor. That exclusive conversation is up next, and this is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Now, Greece became the first major Orthodox Christian country to legalize same-sex civil marriage yesterday. The landmark legislation was approved despite opposition from the socially conservative church. Now, to discuss this, I'm very pleased to welcome Alex Patelis, the chief economic advisor to the Greek prime minister, who joins us now from Athens for this exclusive conversation. Alex, as always, thank you so much for giving us a little bit of your time. This was a landmark decision. What do you think it tells us about Greece today?
Thank you so much. Good morning, Francine. If you recall, it was at this show last summer that the Prime Minister first broached this subject. And yesterday, Greece became the 16th country in the European Union, the 21st country in Europe, and the 37th, country in the world to legislate marriage equality. I should mention that Greece was the 10th country to join the European Economic Community back in 1991, also under New Democracy and Konstantinos Karamanlis. And today, the story you put together, your team at Bloomberg this morning, has a very interesting map that shows precisely what you mentioned before, that Greece is the first country in this part of the world to legislate marriage equality, and we are very proud for that.
Alex, I have many questions on, of course, Piraeus Bank on Athens Airport. But when you speak to investors, when you speak to people that want to put capital in Greece, what do they ask you now?
So there's a election last summer, the upgrade to investment grade, and of course, the global environment looks better. There was an oversubscription of the National Bank of Greece sale a few months ago. Massive oversubscription of the airport IPO, and ahead of us we have the Piraeus Bank sale. We're seeing huge demand there as well. It's likely to happen in the next few weeks, and we are optimistic that this will also be a successful sale. Francine, in terms of the questions investors ask, they're the standard questions. How can we participate in this story? What other opportunities are there? Greece still is a small country with a relatively small stock market, but the upcoming sale of Piraeus Bank shares is one example of how people can participate.
When you look at, and it's great that you mentioned Piraeus Bank, because we know that a lot of investors are looking at that to see also, how much you're selling. I think the Prime Minister said that it would be a significant stake. Would it be the full 27% or less?
That decision hasn't yet been made. It is a decision to be made by the HFSF, but it's looking optimistic at this point.
There's also, of course, the IPO of a 30% stake in Athens Airport that was completed certainly last week. It was a huge success, I think the biggest in 2 decades. Is the Athens Stock Exchange back?
Yes, and the objective now, of course, the sovereign Hellenic Republic regained investment grade last year. The objective is now for the Athens Stock Exchange to rejoin developed market status. Hopefully, an announcement would be made sometime this year with completion next year. You know, there's a lot of debate amongst investors. Some investors say, why don't you want to remain emerging market and be a bigger fish in a small pond? But our view is very simple. Greece is part of the European Union. It's part of the euro. It's a developed market. It has marriage equality now. So, of course, it's going to be part of developed market countries, the stock market. And the airport IPO that you mentioned before also helps that objective. You know, you need large listed companies with large free float to be able to rejoin developed markets.
Is it, now that there's, you know, obviously some investor appetite, will that lead to more IPOs?
Hopefully. I think that is the case. You know, there's still some sectors that are not represented properly in the Greek stock market. Shipping, for example, tourism, technology. There are specific sectors that I believe that the Athens Stock Exchange leadership is looking at. But I should mention here on a different topic as well, it's not just about listed companies. We still continue to look for foreign direct investment. The Prime Minister is headed to India next week. He is a keynote speaker at the Raisina Dialogue on Wednesday, if I'm not mistaken, at New Delhi. And this is another example of an outward-looking Greece. You know, Greece is the closest country to India of the EU geographically, and we want to develop ties between the two countries. There's the potential of the route between India and Europe that is being discussed, and of course opportunities in tourism and other areas.
Thank you so much. Alex Patelis there, the Chief Economic Advisor to the Greek Prime Minister after a very important, of course, day yesterday where Greece legalized same-sex marriage and first for an Orthodox nation. Coming up, we look at fourth quarter results from British bank NatWest, as well as what the new chief executive could mean for the company. We discuss that next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
NatWest has reported a series of fourth-quarter earning beats this morning as they confirmed Paul Thwaite as their permanent chief executive officer. Now, the bank did, however, give a cautious outlook for 2024, saying persistently high interest rates still risk weighing on revenue. Now, for more, we're joined by Bloomberg's Tom Metcalf. Tom, I mean, this is interesting also because now they appointed actually a CEO that's fully in charge. But what were your key takeaways from these results?
Yeah, it's a few things. So it looks like a solid 2023. They did sort of be a bit cautious on 2024 as you see rates coming down. And for me, it was more almost separate things. So their provisions were pretty low, about half of what analysts had estimated. So that's helping. And then, of course, yeah, Paul Thwaite coming in permanently. And that's kind of injecting a little bit of solidity at the bank, which is what they need right now, because you've got the big shareholder, the government, looking to sell down most of its stake.
Okay, motor finance exposure. I mean, you know, this is something that actually some of the Financial Conduct Authority are looking at. Should we really worry about that at NatWest?
Well, I think shareholders are very focused on it. So it's fascinating to see basically NatWest shares shot up after effectively executives said we don't really have exposure to this, because that's the thing right now. Most people thought NatWest was fairly kind of protected from this, but no one knew for sure, I suppose. So hearing that confirmation is actually what's, I think, driving the shares up so strongly today. I think 4.6%.
How will Paul Thwaite actually run the bank?
Well, he's very understated, so, you know, it'd be interesting. I don't think he'll be out there much in the public eye as much as, say, maybe an Alison Rose. And, you know, maybe that's what they were looking for, kind of a steady pair of hands. He comes out of the commercial business side, knows the bank really well, and I think his whole focus will be just delivering sort of stable, reliable results.
Tom, this is such a great story. So Deutsche Bank is tightening its work-from-home rules, joining a growing number of investment banks requiring staff to be in the office more frequently. Now, according to a memo seen by Bloomberg, managing directors will have to come in 4 days a week, while other staff will need to be in at least 3 days a week. But actually, I guess the most important part is that these new rules mean that you can't do Friday and Monday remote.
Yeah, it's a really fascinating memo from Deutsche Bank. So they're kind of aligning themselves, I suppose, with a lot of the Wall Street firms we already know about, the Goldmans, you know, the JP Morgans pushing people in. But yeah, it was that detail, the fact that, let's say you work from home Friday, they're not going to let you work from home Monday, and that's kind of cribbing away that sort of 4-day from home sort of section. So it's really interesting, and I think it's interesting it's Deutsche Bank as well, because most German lenders have been quite sort of generous on the work from home approach. And this is, again, showing that at least in Wall Street, at least in high finance, really the end of work from home, as at least we've known it for the last few years.
I mean, and everybody's trying to figure out whether that means you can't attract top talent.
Well, this
is there
the
a
big
correlation?
debate. Well, it's really interesting. I think, you know, I think in high finance there is a recognition, you know, you need to be there for your clients, you need to be in the office. So I think that's the view bosses take. But of course, you know, on the employee side, you know, if you get an offer where someone's saying, hey, we've got much more flexibility, I think that is becoming very, very important. And actually, you know, dare I say it, you know, up there right with pay as well.
Tom, thanks so much. As always, Tom Metcalf, they're in charge of finance. Up next, the Bloomberg Brief, Danny Berger and Manus Krani in New York. And this is Bloomberg. Happy Friday, everyone.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The Fed's Raphael Bostic says there's no rush to cut interest rates. Markets now await producer prices and a consumer sentiment report due later today. We'll take stock of a flurry of news on artificial intelligence as Apple readies an AI tool to rival Microsoft. Plus, government and industry gather at the Munich Security Conference. We're going to talk energy security with Andrew Forrest, the billionaire chairman of iron ore miner Fortescue. You made it to Friday after a slew of data that, let's be honest, it was like a choose-your-own adventure. What do you listen to? A hot CPI report, or maybe weaker retail sales, or maybe jobless claims that declined? Well, if you're in this equity market, you want to listen to the bad news that was good news. That is the weaker retail sales. You see equities hit yet another record. We're higher again this morning by 0.1%. Bank of America says the 4-week inflow is the strongest since 2022. NASDAQ, that outperforms thanks in part to Applied Materials. Those shares moving higher in the pre-market trade. You can see that at the bottom of your screen by 13%. A positive update for the current quarter that we're in. Maybe the chip slump is over. Finally, the Nikkei closing at just under its highest level since 1989. We almost got there. We were so close, but it was really thanks to the tech rally, to that Applied Materials earnings call that really helped to ignite tech in Japan. Now, when it comes to rates, this was maybe a little bit more confused. You had the retail sales data come in first, and the initial reaction was yields down, a rally in treasuries. But then we hear from Bostic late yesterday, saying that he's not so sure we are on a sustainable path to 2%. That in turn goes to a sell-off. We're up by about 3 basis points. In the UK, we had retail sales data. That comes in stronger than expected. Not enough, though, to deter the sterling bears. Cable is down this morning. 125 is where we sit. And meanwhile, Brent crude down almost 1%. After a rally of 1.5% yesterday. Now that rally yesterday, again, it was about the data. And investors and the Fed are waiting for the next patch of data for more of a hint on the rate path. Again, as I said, we're going to get PPI today. Here's what Sophie Huyn of BNP Paribas had to write on the overall sign of things right now, that signs of cracks are starting to appear due to 2 years of monetary policy tightening while inflation remains sticky. Pleased to say that Sophie joins us now. She's senior cross-asset strategist at BNP. Sophie, what do you make of this data, of this confusing data? Is it this, that there are cracks, but inflation is still high?
I
think what the market is pricing right now is the fact that inflation could remain a bit sticky in the near term with a downward bias, but overall converging towards 2% over the next year. And you see how the one-year inflation swap has been repricing. So it's currently at 2.35%. It was at 2% early February. So at this point with the retail sales, what the market is not pricing yet is inflationary pressure that could basically go with US GDP still growing at above trend. And we still don't know. So the decoupling is giving opportunity to invest still in risky assets, but that remains to see how long it could last.
Is there not a fear, though, that we've gone too far in risky assets? Michael Hartnett over Bank of America points out that the Mag 7 have contributed to 75% of the S&P 500's gain. Does that not end in tears, Sophie?
So there's two things. If you look at the U.S. equity market without the Mag 7 and IT, actually the S&P is trading at the same 12-month forward P as European stocks, around 13 times. I think what is much more problematic is how you deal with this big stocks, so the Mag 7 and IT sector, where in terms of 12-month P for me doesn't mean anything. Why would you look at the next 12 months of EPS growth, where these tech stocks have much more forward-looking and back-end cash flow? So if you try to back out the long-term EPS growth through what you call the little g, you basically see that these big stocks are pricing 3% more in terms of EPS growth than the average stock. So the question going forward is, do you think it's reasonable?
I mean, is that reasonable, Sophie?
I think it depends on how you perceive AI. So if you think that AI would basically translate into massive productivity boost and that would benefit the average stock, then the question is, why are you still in this Mag 7 IT? Why don't you play through like the average US equity stocks? But if you believe that there's going to be a cannibalization and only this Mag 7 IT sector will benefit from AI, then it makes sense to still stick to it.
So for your other call, and this is quite the contrarian call, considering what Chinese equities have done, is to be long China equities. They're down some 50% from their peak in 2021. So the argument I usually hear is, look how cheap these things are. At some point, they need to mean revert. If that's the technical side of things, what is the fundamental reason for you to be long China equities?
Yeah, the cheapness is one argument only. We don't really look at that. So I think there's two things to look at for Chinese equities. And I think these two hurdles have more or less been overcome at this point. So the first one is the short-term hurdle, which was people being quite pessimistic about the policy response and how slow they have been in responding into deteriorating growth fundamentals, especially the bad news on the property market. But actually, since October, you see that actually policymakers are quite concerned about the growth outlook, and they've been stepping up in terms of their policy response. Stimulus have been going in, and we're likely to see the result of the stimulus in the next couple of months. So that floor put on China growth would be a good catalyst for Chinese equities. And then the second part is more the medium term, and how much Chinese assets you want to invest given the geopolitical concern. I think we're past that with investors kind of like already cutting their Chinese allocation by half. And the fact that we're already over that in terms of portfolio readjustment, I think in terms of positioning, it's much more cleaner than before.
So, Sophie, I can't let you go without asking about Bostic's comments yesterday, because it did single-handedly seem to undo the Treasury rally. He said that the evidence from our data, our surveys, and our outreach is that victory is not clearly in hand. It leaves me not yet comfortable that inflation is declining to our 2% objective. I know you're bearish on the dollar. Does a comment like that make you reconsider a bearish dollar position?
We're medium-term bearish on the dollar on the expectation that the U.S. yield curve would bull steepen, which would trigger a bearish dollar trend. But actually, in terms of what we're looking at and focusing on in terms of asymmetric trades, we're paying too much attention to the Fed. We're giving too much credit to the Fed. If you look at the trash rally that supposedly Powell started, ARK started to rally, and the small caps and non-profitable tech, they started to rally end October, so before Powell. So where we see where there's the most asymmetry is actually in the UK. Why, in terms of forward rates, UK forward rates are at the same level as US forward rates? It doesn't make sense at all. And we think that being either long gilts or long euro sterling are the best trades to have and to hold this year.
Sophie, I think that is the comment of the week. We're paying too much attention to the Fed. We're going to have to leave it on that note. Sophie, thank you so much for joining us. Sophie Huyn of BNP Paribas. Let's get some of the other top stories that are trending on the terminal this morning. The White House says that Russia is developing an anti-satellite capability, but that is not yet active and poses no current threat. The statement comes after the House Intelligence Committee Chairman Mike Turner warned of an unspecified national security concern. Bloomberg has also learned that U.S. intelligence shows Russia is discussing the possibility of a nuclear weapon in space. Santander is increasing bonuses for its investment bankers after it posted record profit last year. Variable compensation in the corporate investment bank is set to rise by 10% on average. The bonus decision follows a push by Santander to expand its U.S. investment banking operations. Meanwhile, Deutsche Bank is tightening its work-from-home rules. It joins a growing number of investment banks requiring staff to be in the office more frequently. According to a memo seen by Bloomberg, managing directors will have to come in 4 days a week, while other staff will need to be in at least 3 days a week. Those changes are effective from June. Jeff Bezos has unloaded another 12 million shares of Amazon valued at $2 billion. That brings the total sold in the past week to over $6 billion. He had earlier disclosed plans to sell as many as 50 million Amazon shares. Now that sale also comes because he recently relocated to Florida from Seattle, and it's a move that could save Bezos millions in taxes as he sells those stocks. Okay, coming up on the show, Andrew Forrest, the executive chairman of mining giant Fortescue, is going to join us live from the Munich Security Conference. Stick around for that conversation. Plus, the job cuts, they keep coming. It's the turn of Nike now, reducing 2% of its workforce as it battles the growing competition. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Brief. I'm Danny Berger in New York. Climate change and international security are on the agenda at the Munich Security Conference this year. I want to go straight live to the conference and talk to one of today's speakers. It is Andrew Forrest, Executive Chairman of the giant iron ore miner Fortescue. Twiggy, thank you so much for joining us. It is wonderful to speak with you. Look, you're at the security conference at a time where it feels that tensions in the world have reached a fever pitch on multiple fronts. I'm sure the conversation is a lot around that. I'm sure it is abundant there. On those conversations on geopolitical risk, how would you characterize them right now?
I think everyone is really concerned about the flow of critical minerals, about the flow of energy. I've just made the point. If you prioritize human rights, say particularly Germany encourages through the Corporate Responsibility Directive for Human Rights, if you encourage your suppliers to go green, if you make sure that their environmental standards are the best in the world, then you're going to diversify your supply chains. If you don't do that, then your supply chains are going to concentrate just to those suppliers who don't actually register those things with the same potential, the same priority as we all do. And then you'll find you'll just be dealing with one or two suppliers on economic grounds. That would be a massive mistake for the world. So prioritising human rights, environment, and going green will actually diversify supply chains massively. Danny, there's no shortage of rare earths. Rare earths is not rare at all. There's no shortage of nickel or cobalt or lithium. It's abundant. It's out there. And I'm just getting that message out. Actually diversify your supply chains by supporting human rights, environmental responsibility, and going green.
Well, amid that, Twiggy, the world also potentially has to prepare for Trump 2.0. He's certainly leading in the polls. And when Trump has talked about renewable energy, he's called it a scam business. Do you think that the world of energy security and the diversification you're talking about, will it be set back if there is another Trump presidency?
Look, I think for any future government of the United States, it'll need to consider the quality of living of its people. So you'll want the cheapest energy you can possibly get, and that is renewable energy. You'll want the cleanest energy because, you know, all throughout the Midwest, they're starting to get heat waves coupled with humidity. It's killing off livestock. It'll kill off humans if we don't act on this. So I think those messages will be getting through to any future administration. But I would say this in a very binary way. The United States relies, this government, any future government, on its allies, on its particularly Asia-Pacific allies. The strongest, of course, is Australia. If any future US government were to encourage the Ukrainian people to give up their country in favor of being invaded, in favor of bloodthirsty, absolutely horrible behavior against human rights, which we're seeing from Russia's invasion of Ukraine, then I would say think very carefully about your allies staying allied to you.
Yes, and you know, that feels like a not-so-subtle hint of Trump saying that if he were president, that Ukraine should quickly end the war. He also talked about this idea of a two-tiered NATO system. Andrew, it's not just the Asia-Pacific. What does that do to fracture the more Western world, if that's the kind of language being used in a campaign?
Look, I think politicians use points of difference to try and create a point of difference when there really isn't any. Both sides of the US government, both sides of any responsible parliament will go for justice and fairness in the very long term. That includes human rights, it includes environmental responsibility, and of course must include now recognizing that fossil fuel is the cause for global warming and future and existing major destruction, so we must go green. Now, to ignore all that or to, say, encourage a Russian victory in Ukraine would be universally rejected, I think, globally and worldwide.
Yes. Andrew, while we have you, we have to talk about Fortescue as well. And last week, reports that the president of the European energy arm was set to depart. That would be the 6th executive in under 6 months. As the executive chairman, I have to ask, does some of that responsibility fall on you to stop the flow of executives leaving?
No, look, I don't make those decisions. I have really great people in place, two great chief executives of metals and energy. They are making those are decisions. By the way, they employ 22,000 people. You talk about 6. I mean, we have up-and-coming people, younger people, cross-gender, who really deserve to be given those positions of responsibility. Good people such as the person you just mentioned out of Europe recognize that and decide to step aside, move on after mentoring those people. So I look at it as I've been told, a natural and very healthy progression of a very large company. I think it's a complete storm in a teacup. You look at the board of directors, you look at the people who have built this company. We've been there for 15 or 20 years.
So Twiggy, is it fair to say then, nothing to see here, you don't need to change anything at this moment, that you're comfortable with the way the leadership is structured, even if you have seen those departures?
Yeah, look, if we didn't have this dynamism where we are changing the company for what it must be to meet all the future challenges of our world, to be the green energy, green metals, green technical solutions company, green electricity solutions company, then we must continue upskilling, we must continue changing, we must continue maximizing gender,
Twiggy, I got to jump in because we're running out of time
and that
here.
means that people are stepping on.
And I want to ask about China, because obviously this is a big issue for the metals market. There's a concern about a glut. Construction season begins in March. Do you think the fiscal stimulus we've seen is enough to counteract some of the weakness in the economy? And apologies, only a minute here, Twiggy.
Okay, if you're asking me, should we be worried about critical minerals when there's a glut of critical minerals, the price is right down? I would say what we need to be worried about is diversifying your markets, and you'll do that if you insist on high standard of human rights right here in Europe with the Corporate Responsibility Directive, if you insist on environmental practices which are up there with the best in the world. Even deep sea mining is a complete joke if you don't do the longitudinal environmental and ecological studies which we do on land. And of course, going green. These are the 3 parameters which, if you insist on in Europe, North America, Australia, you'll have a much more diversified supply chain.
Right.
And you won't have a glut of one supplier swapping out and swamping everyone else.
Okay. Andrew Forrest of Fortescue, thank you so much for joining us this morning. Go enjoy the rest of your time in Munich. I'm sure more important conversations to be had ahead of you. This is Bloomberg.
Very short period of time. Yeah. Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from, just seems to me like such a amazing transformation across the globe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are 2 weeks away from the latest deadline to avert a U.S. government shutdown. And according to Congressman Tom Emmer of Minnesota, the Republican majority's top vote counter, the U.S. House will not pass another stopgap spending bill. Here's what he had to say on Bloomberg's Balance of Power yesterday.
You're not going to get another continuing resolution out of our conference in Congress. The last one was difficult, and that was done because our speaker recognized that there just wasn't enough physical time to process all the bills once the House and the Senate had agreed on the top line numbers. So this time you're going to have to get these things passed, and they're talking about you won't have time to do 12 individual bills. They're talking about doing them in something called minibuses, maybe 3 or 4, where you put 3 or 4 bills in each one and pass them as a group.
So you get these minibus bills passed. In a perfect world, the president stops by and delivers the State of the Union that night, and you still have a couple of major issues to deal with, Congressman, including the matter of foreign aid. The Senate sent you a bill that the Speaker says is DOA, and I know that you're working on what some in Washington are calling a Plan D for dog. What's that going to look like, and can you pass it?
Well, Joe, I think people forget that we passed an Israel bill back in October. They've already got a bill over there that came from the House on the stuff that they sent over. Remember, this was going to include border security. Once they could not perform on the border security side of it, then they sent over a bill that had everything in it that will not, you can't pass it on the floor. You'll have to break it up. You'll have to downsize it. Ukraine is a great example. You don't need $60 billion. You can take the humanitarian aid and the government supports, make that the responsibility of the EU, who just committed 10 billion euro over the next 10 years. There's a way to do this, but not the way the Senate has sent it over.
Okay, but what would yours look like? Is there a Plan D that's about to emerge?
Well, look, bottom line is you've got a White House and a Senate that are apparently used to working with a Nancy Pelosi-controlled House. You've got a new majority in the House. You have to talk to the Republicans, and you have to work with the Republicans. So I would say that when it comes to the border security issue, let's see if we can figure out how to get that done, because Americans, 80% of Americans want the border sealed.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Here's what you need to know. The Fed's Raphael Bostic says there's no rush to cut interest rates. Markets now await producer prices and a consumer sentiment report later today. We're going to take stock of the flurry of news on artificial intelligence. Apple is readying an AI tool to rival Microsoft. And Nike will slash its global workforce by about 2% as the sportswear giant seeks savings. It was a choose-your-own-adventure data dump yesterday. What do you pay attention to? CPI that came in hotter than expected, weaker retail sales, or maybe jobless claims that unexpectedly declined. If you're the stock market, you pay attention to the news you like, and that's probably that weaker retail sales data. Stocks gain after a record high for the S&P yesterday. You are seeing outperformance in tech, perhaps thanks to Applied Materials earnings, which is up some 13%, 12% in the pre-market trade after a good, solid forecast for this current corner. Chips, they are back. They've recovered through the slump. There's where the Nikkei closed. It is just below its highest level since 1989. We almost got there. When it comes to rates, there was a sizable rally off the back of those U.S. releases, but that undid itself by the end of the day, perhaps aided by some of the comments from Bostic. We'll get into that in a moment. UK retail sales, those also came in stronger, but the sugar rush of better eco data is not doing anything to support sterling. I mean, retail is just such a small part of the UK economy, so perhaps that isn't enough to shake things up. Brent crude drops by 1%. It was higher by 1.5%, thanks to that risk rally of yesterday. Okay, I teased it. I mentioned those Bostic comments, so let's hear from the man himself. Here is the Atlanta Fed President, Raphael Bostic.
The evidence from data, our surveys, and our outreach says that victory is not clearly in hand and leaves me not yet comfortable that inflation is inexorably declining to our 2% objective. And that may be true for some time, even if the January Consumer Price Index report turns out to be an aberration.
Joining us now is Parag Garvey, America's head of research at ING. Parag, we had such a clean narrative to start the year that there'd be cuts, that the data was declining, inflation was going down, but then we get Fed speakers saying different things, we get the data all confused. Where do you stand now?
I didn't believe it to begin with, Danny, to be honest. I came in January, the first week of Jan, we saw a March rate cut, practically 100% discounted. I mean, for me, it was the biggest reason to go bearish in treasuries from the beginning of the year. And I'm not just saying that because I'm sitting here now and I was right. it was a pretty obvious one for me. And the narrative since then has been questioning whether the Fed can cut to the extent that the markets were discounting at the beginning of the year. Remember, the markets were discounting 7, 8 cuts at the beginning of the year. And we've moved now to 4 or 5 cuts over the next 12 months. Right. Big change, and that's the reason treasuries have done what they've done.
Parag, let me tell you, if you're willing to get up and get into the studio at 5:30 in the morning, you can take a victory lap if you want. If that's the only thing you want to do when you join, you are more than welcome to. So your call, I know you're bearish bonds, but you do write that at some point, yields go down to 3.5%, which you say will be an overshoot. What is the mechanism for why we get there?
Yeah, so it's a bit of a nuanced view because let's just take it back to the CPI for a moment. Sure. 0.4%, even before we had that 0.4% print for core CPI inflation on the month, 0.3 was still not good enough. 0.3 times 12 gives you 4.2%. So we were looking at annualized inflation of 4%. Hence, I fully understand where Bostic is coming from. I also think this is a very woke Fed. They're very concerned about housing costs, and that's a part of the core CPI index. So that drives us up as well. Now, the route back down again is where we do get rate cuts, because while I'm here talking bearish in treasuries, I do believe that the economy is vulnerable. And we will get to the point where the Fed does cut rates. And when we really are facing into rate cuts, that's when bonds can really move to the downside. The one nuance I would have, however, is that when 10s go below 4%, that's the beginning of the overshoot to the downside. It doesn't stay down there, but it gets down there because of all this excitement about rate cuts.
So is 4% fair value, it just undershoots there and floats back up?
Yeah, I think we've got to take a 3% funds rate as neutral. We can have a conversation about that, but I think that's neutral. I want to see a 100 basis point curve. Traditionally, curves would be 50, 75 basis points when the Fed is finished cutting. This time it needs to be steeper because of the size of the deficit. And I think that's, if anything, an underestimate. So anything below 4 is an overshoot to the downside.
This question of the deficit, and we can get to where the neutral rate is. We might not have enough time because I feel like that's an hour-long conversation. But this concern about the deficit, because I know you write about this too, that that markets are ignoring the issuance volumes, but we've had fine demand for all the bond auctions over the past couple months. What changes to make us nervous again?
It's been phenomenal. You look at the beginning of this year, we had the refunding announcement, another record high from the Treasury. It's not just governments, it's corporates, it's the entire primary issuance market is on fire. Credit spreads super tight, huge demand, absolutely.
Yes, insatiable demand.
Absolutely, but we're getting excited for two reasons. One, the economy is holding up and the Fed is going to cut rates. Two huge positives, and it's just keeping investors interested. This demand for bonds continues until the Fed cuts rates. Now, after the first couple of rate cuts, the novelty wears off, and we begin to worry more about supply. So the supply pressure doesn't go away. The Treasury won't increase supply, but it'll keep it elevated for the rest of this year and into next year. And that's why, if 10s go down to 3.5, they don't stay there. They get back up to 4, and next year we'll be having an argument as to whether it should be 4 or 5 because of the supply pressure.
I look forward to having that argument. On corporate bonds, I love that you bring this up because we have been so obsessed by Mag 7. Is there a bubble in Mag 7? Is it frothy? But I look at the corporate credit market, so much demand there. Spreads are historically tight, even though the data I saw was we had defaults at a multi-year high last month. I mean, not recessionary high, but still high. Do you look at that and say, maybe I shouldn't be so bearish bonds, that the demand is there? Or do you look at that and say, this market is frothy, this ends in tears?
It's so hard to be short.
Yeah.
It really is. There's such a weight of money behind this get long credit story. It looks really tight.
Yeah.
And the central narrative is that over the course of the next number of quarters, we will go wider, absolutely. But, I think it's interesting that if you look at the information set we're dealt with, there absolutely are pockets of weakness out there. Look at the job losses, the miscellaneous job losses being announced practically on a constant basis every day. We're seeing little trickles. But then you get payrolls of 353, and you get 0.4% core, and you realize, well, the economy is still pretty hot. At the moment, the focus is on these choice data sets that are rationalizing the market doing what it's doing, which is tighter credits. Treasury is not doing an awful lot, a bit higher, but waiting for the rally in treasuries.
You're right. The figure last week was 32,000 tech job cuts, and then we had more news this week of 4,000 from Cisco. We hear about Nike today. So does the change happen when that shows up in the macro data, or are you saying that just something has fundamentally changed with the way we measure these things, and it's just going to continue to look okay on the surface?
It's going to look okay on the surface. We had jobless claims last week again, really low number. We continue to not have stress in the labor market. We will have it, though. A lot of these jobs are white-collar worker jobs, and very often layoffs don't mean that you're going to go off and claim straight away. So there is a bit of a lag there. But we need to see it in the payrolls numbers. So for me, there's two things I'm looking for. I'm looking for the next payrolls print. Now, you know, it's old school, but I mean, that's really important. That's 3 weeks away. And I'm looking for the next core CPI print. Along the way, we're going to see weakness. We're going to see PPI today, which is going to be low. We're going to see inflation expectations, which will be fine. We'll see all kinds of other elements that are pointing to risks. But those two are really important for me.
Okay, well, we'll have you back on after so you can do another victory lap yet again. Paul Rick, it's really wonderful to see you this morning. Enjoy the rest of your Friday and your weekend. That's Paul Rick Garvey of ING. Okay, coming up, beautifully filmed shots with gorgeous scenery, except none of it is real. The new OpenAI tools that you have to see to believe and are probably coming for my job, let's be honest. We'll discuss that next here on Bloomberg Brief.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in New York. Now, yet another company is cutting jobs. This time it's Nike. It announced it will reduce 2% of its workforce to help cut costs and growing competition. Joining us now is Bloomberg opinion columnist Andrea Felstead. I mean, Andrea, what competition is new here? What exactly has changed that means Nike needs to let go part of its workforce?
I think there's quite a lot of things going on in sportswear at the moment. You've got a bit of a shift from casualization to more formal dressing as we all go back to work, go out to restaurants and bars again. Plus, we've talked a lot about this aspirational luxury consumer, which is cutting back on sort of Gucci handbags, you know, Burberry baseball caps. They will be exactly the same customer that is shopping for Nike sneakers. Finally, you've got something else going on. You've got a lot of competition for the likes of Nike and Adidas from brands like On, Hoka. That's all taking its toll.
Yeah, no, it's a good point. I mean, you see a lot of those shoes out and about, ones that you wouldn't see before, those trendy Hoka ones. Maybe I need to get on board with that too. Does cost cutting help them with that, though, Andrea?
No. What these companies really need is the right products. We often forget that these businesses are actually fashion brands, and what they've had is they've become too reliant on a few key styles. So at Nike, it was the Jordan. At Adidas, it was the Stan Smith. Then it was the Yeezy. Now they're looking at the terrace sneakers like the Samba. And what they need to have is a pipeline of these looks coming through, so that as soon as one dies, another style can pick up the baton.
Andrea, we need to let all the viewers know the title of your latest opinion piece. It is How Mob Wife Killed Coastal Grandma, which does sound like the plot of a Sopranos episode, but it is not. It is about TikTok trends and beauty trends. I told you during the break I should have worn a fur coat in preparation for this opinion column. But what does it mean for brands to try to keep up? If the latest thing is mob wives, which is so different than Coastal Grandma, how in the world do they keep up with something like that?
Well, it's very interesting because actually TikTok is a reflection of what's already in the stores. You know, fashion commentary has been democratized. We're all fashion critics now, and we can put together an outfit in a particular style, but we need to be able to buy those clothes in a store. And it's interesting because fake fur was already in the stores. It had already come through as a look. Leather's been big for a while. Animal print, you know, some people say animal print is a neutral because you can wear it with so many things now. And we've put all those together into Mob Wife. Now, I think Mob Wife has probably peaked, but some of those elements like fake fur will still endure to the autumn.
Oh, it's peaked, and I was just ready to get out my Carmela Soprano outfit. Andrea, thank you so much for joining. Go read her column. That's Bloomberg opinion columnist Andrea Felsted. All right, let's get into the tech trends now. Apple is preparing an AI tool that would rival Microsoft's GitHub Copilot, according to Bloomberg reporting. Joining us now is Bloomberg's Alex Webb. Alex, this is one of maybe 1,000 stories that came out yesterday that feels like this AI war between different parties. What is this latest one between Apple and Microsoft? How big of a threat is Apple as a newcomer to the kind of GitHub model?
It's more of a sort of defensive move for Apple, often the strength that Apple has when it comes to, you know, rivals in hardware is the fact that it has such a rich network of developers. There are millions of people developing for Apple's platform, so it means that when you buy an iPhone, you have in turn millions of apps that you can download. As we see the rise of new sort of platforms in the form of AI, we've got, of course, OpenAI offering ways to plug their models into all sorts of different offerings. Apple needs to do something to ensure that people are going to keep developing apps for its platforms. This is something that will help them do that and make it a little bit easier for developers to keep working with Apple's operating systems rather than being tempted to build for others.
Now, I know OpenAI has a bit of competition too for Google, but before that, I just want to look at these videos from OpenAI that turns text into realistic videos. I mean, this is crazy, Alex. This is what takes my job, right? Like this is exactly the thing.
I'm not even really sure I'm talking to the real Danny Berger right now. It could well be an avatar. No, I mean, look, let's put this in a little bit of clear light, or approach it with a slightly clear eye. It looks really cool. It is very impressive. We're sort of at this phase in AI, which is comparable to the early days of the space race. If you remember, and bear with me on this one, you saw the Soviet Union at the time send a human into space. Then they sent a dog into space, and they sent a human into space, and they sent the first woman into space. And every single time, it was a new first, but actually, it was sort of a version of a thing they were doing already. This is something, and they weren't actually going to the moon, which of course is then what the US did later. We're sort of in this phase with AI. This looks really cool. It is kind of an iteration of what we're seeing already with text. It's just they're applying the same tools to video. They're applying the same tools to photos. It is just kind of iterating on that theme. It's when it starts to get into really new spaces of technology, when you think about agents, you know, how AI might interact with, for instance, a restaurant to make a booking with you. That is something, a booking for you. That is something that's a little bit different than just generating new and slightly better content.
Still worried. That didn't make me feel better literally at all, Alex. That just made me more worried, if anything. But OpenAI also wants to take on Google with its search tools. I mean, this was a reason that Alphabet fell yesterday, but wasn't Microsoft already doing some sort of search that would incorporate OpenAI? What exactly is the difference here?
Yeah, I'm slightly surprised by the market reaction, particularly in Alphabet shares, which, as you say, they lost, I think, 3% and a bit following this news. I thought we kind of knew this. We knew that OpenAI, that Microsoft with Bing were kind of coming for Google. They've been doing a few things in that space. So far, it hasn't been actually all that impressive. What the news is here, I'm not entirely sure, to be honest, and how it moves the story forward. But it perhaps is a reminder then for investors that, hey, this battle isn't yet over. What they were doing already isn't actually the end of the story. And you still got to remember, though, Google has like a massive advantage in this space. It's not something that's easy to do. So, you know, it's interesting. I'm surprised by the market reaction.
Right, and this is one of those things that are just so sticky. If you have a search engine, if you've been using Google for, I don't know, how long have we been using Google as our go-to search engine? It's likely to be the one to continue to do that. Does that mean Google has an advantage, Alex, when it does things? For example, it's announced a free AI tool to help bolster online security. Because you live in the Google ecosystem with search, with email, with docs, with Drive, is this going to give them advantage, not just for search, but for anything AI they might give to the public? Because we already live in that ecosystem.
I mean, there's a part of that. Sometimes I think stickiness is a little bit overplayed. If we think about Facebook was supposed to have insurmountable network effects because all your friends were on Facebook, and yet, of course, now everybody's using TikTok. I think that with Google, like, the way that Microsoft seems to be looking at this is that they don't really need to be making money, right? They can just be taking chunks out of Google in search, and that actually helps them elsewhere in their business. It means that Google will find it harder to subsidize the cost of, say, Google Docs or of Google Cloud, which is something that competes directly with Microsoft Azure. If Microsoft can take chunks out of Google's real cash cow and search advertising, then that's something that behooves Microsoft, and it seems to be at least part of what the strategy is.
Alex, before I let you go, away from the world of AI, I mean, I guess not completely away from the world of AI, we did have Applied Materials earnings yesterday. The market loved it. It was up nearly 13% pre-market. I think it's still around there. I know it's hard to disaggregate the different types of chip makers, but does this show us that the worst of the chip slump is over, that we're on the up and up now?
Well, it seems to suggest that the chip makers think that's the case, right? What Applied Material does is they make the machines that in turn make the chips. So if they're showing good numbers, it means that the chip makers are ordering machinery because they're expecting the need for more capacity in maybe a year or 18 months' time. So it's a good sort of leading indicator of where the chip makers think the market is going to go. Does that mean that there couldn't be a surprise and that actually there's a supply chain disruption or something happens which actually turns the market on its head? That is still possible. What we see in chips is a real sort of concertina effect where it comes in waves. Sometimes there's oversupply, sometimes there's undersupply, and the time it takes to react to each of those is so long. It's maybe 18 months to bring a chip fab online, that by the time they've done it, actually the market has moved on again. So it looks promising for the chip industry, but never say never.
Alex, thank you so much for joining us this morning. We really appreciate it. That is Bloomberg's Alex Webb. Okay, coming up, we're going to set you up for the last trading day of the week, some of the market-moving events for you to watch throughout the day. A lot more data on deck. Is the narrative even more confused by the end of today?
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
It's Bloomberg Brief with Danny Berger in New York. By the way, if you are missing Manus Cranny, stick around for the next 10 minutes. He's going to be showing up anchoring surveillance. Now, along with that, let's get a look at what else is ahead today for your trading day. We're going to get a slew of economic data out of the U.S. We're going to get PPI and housing starts at 8:30 a.m. The UMich sentiment, that will hit at 10 a.m. Eastern. Then more Fed speak. Richmond Fed President Thomas Barkin will be at 8 a.m. Eastern, as well as San Francisco Fed President Mary Daly. She will speak at 12 p.m. Eastern. Now, in the meantime, let's get a look at some of these macro movers. We had DoorDash results after the bell. The guidance failed to impress. So shares are down about 7.33%. Their full-year marketplace gross order value trailed the average analyst estimate at the midpoint. I'm looking through the analyst notes, though, and I have to say they are still pretty bullish on the stock. Truist says, use the stock sell-off after hours as a buying opportunity for virtually in-line guidance for a company that usually beats and raises estimates. So the sell side still likes it. Roku, meanwhile, falling 15%. First quarter forecast from this streaming video platform was also seen as underwhelming. Then Coinbase, a nice rally for them. Their fourth quarter revenue earnings beat estimates. By the way, Bitcoin is back at 51,000. It's almost been a quiet rally underneath the surface since we got that ETF, all those ETFs coming to market. The fanfare, maybe it wasn't a big splash and a bang, but still gaining steadily on Bitcoin. Okay, your check on bonds, because we are going to get data out today. We have UMich sometimes shakes things up, but increasingly those surveys are just political, let's be honest. In the meantime, it is PPI, things like housing starts. Will it give us a clear picture of this American economy? Bonds are on their way down this morning. Yields on their way up. We're about 3 basis points higher this morning. A lot of that has to do with Bostic, who said he is not confident we are reliably on the path to 2%. UK yields, those also move higher after hotter than expected retail sales data. Those move up by about 4 basis points. Germany also up by another 2 basis points, essentially just following what else we're seeing from the U.S. and American market. All right, that's it for Bloomberg Brief. Surveillance is up ahead. You're going to see Manus there. Stay tuned, won't you? This is Bloomberg.
baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Could face bigger challenges next.
Was going to keep bringing World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The longer that financial conditions stay tight and rates are restrictive, you will see that impact activity and see things slow down.
We are expecting a slightly slower economy. We think that that will open the door to rate cuts.
You'll probably get some capital appreciation if the economy slows, as we think it does, towards the end of the year.
We think the trend is still towards disinflation. The Fed will probably be cutting in May or June.
It feels like the uncertainty this year seems to be higher than it was last year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We've almost made it. It is Friday. Good morning. From New York City for our audience worldwide, this is Bloomberg Surveillance alongside Anne-Marie Hordern and Manus Cranny. I'm Lisa Abramowitz. Jonathan Farrow is still off. He will be back next week. I have to say, this week has been such a muddle. And one thing that I keep repeating to myself, other than good morning, is this idea that the economy is not the stock market. The economy is looking like a muddle, but the stock market, Manus, is looking very good.
I mean, it's lit up. I mean, if you look at Nike cutting their jobs, Cisco cutting their jobs, and you're right, the equity market continues to power higher, and it's about the flow and the breadth. And that's what Hartnett at Bank of America says this morning. Over the past 4 weeks, you're looking at some of the biggest inflows, $60 billion, the biggest inflows since 2022. But it's the breadth that he focuses on. U.S. equity breadth is the worst since 2009. And to end the mania, because in his theory, it is mania, this tech mania, real rates have got to get to 2.5% to 3%. But that's not going to happen.
Well, exactly, but that's exactly why people are taking off the table, which is part of the reason why you saw a rally in bonds. The reason why people are so focused on the lack of breadth is because NVIDIA reports next week, and that's been such a huge bulk of it. If you look under the hood, delinquencies picking up on consumers, retail spending really soft. And yes, some people say it's seasonal, but Manus, a lot of other people say it was so broad-based, it's hard to just dismiss this.
It takes me back to the one line from Paul Donovan. I think you mentioned Paul Donovan's note this morning about something else, but it is that wonderful phrase about the hedonism of the U.S. consumer. And in the end of the day, it is about credit card. The delinquency levels are not extreme. They are rising, but they are not extreme on autos. They're not extreme on any of the leverage in the system here. And the last thing the American public will do is stop spending on their credit card. And we haven't reached the end of that track yet.
I have to say, you talk about American hedonism. It seems like Europe is getting a little sick of it, Anne-Marie. I was reading the Ursula von der Leyen in the Financial Times this morning, and we're hearing a lot of rhetoric ahead of the Munich Security Conference about how Europe may have to go it alone a little bit more.
So I think on one hand, you have Kamala Harris, the vice president, going there, and she's going to talk about U.S. isolationism and how the U.S. should not be isolated. She's not going to mention Trump by name, but obviously those remarks have one individual and his recent comments about NATO in mind. And then Ursula von der Leyen talking to the FT, talking about a, quote, rough world ahead we live in. She wants to subsidize the European Union's defense structure, kind of like what they did with COVID, similar to what they did with natural gas when Russia invaded Ukraine. So even though you have current administrative officials going to Munich and they're going to say, we stand side by side with our NATO allies, I think the writing's on the wall for Europe that they need to do more. And this was a theme we saw over and over in Davos.
How much is it notable that Kamala Harris is the one that's kind of holding the helm for the United States?
Well, she has gone to the Munich Security Conference, and given the fact that we are going towards a November election, she's going to have to be front and center on some of these really important stages, because there are still a lot of questions about President Biden's age, and you saw that overnight in the CBS poll.
I love this New York Times quote. While no one in the White House will say this too openly, Ms. Harris's challenge in the campaign is to demonstrate that she is up to the job so that voters will not worry about re-electing an 81-year-old president who will be 86 at the end of a second term. Let's take a look at what's going on in markets right now. You are seeing another lift to end the week as people really do see those flows that Manus was talking about. The largest, as he mentioned, since February of 22 into equities, so solidly across that 5,000 line. Another lift today, 0.2% gain, 50 of 56. You could see a bit more dollar strength today. Again, this is a somnolent pair. This is a pair that's going nowhere as people try to parse through the ECB speak, the Fed speak, the strength in the U.S., the weakness in Europe, and what that means. 107.69. And what you can see elsewhere is a little bit of a lift to yields. And I'm really focused on today's PPI data, especially because it does dovetail into PCE. How much do we see some sort of retracement of the CPI that we saw earlier this week in terms of hot inflation? Coming up, Anwidi Bahugana of Northern Trust as the S&P 500 closes at yet another all-time high. Norman Rule, former senior U.S. intelligence official with tensions continuing to escalate between President Biden and Israeli Prime Minister Benjamin Netanyahu. And Ian Shepherdson of Pantheon Macroeconomics ahead of U.S. PPI data to round out the week. We begin with our top story, the S&P 500 hitting yet another all-time high. Market selling off briefly after CPI on Tuesday, gaining background ahead of U.S. PPI due this morning at 8:30 a.m. Anwidi Bahugana of Northern Trust still expecting a soft landing. Quote, a deeper dive into growth and inflation dynamics convinced us to maintain our outlook for deceleration in U.S. growth. Forward-looking drivers of labor demand and supply suggest this slowdown is likely to come. Anwidi joins us now. And Anwidi, thank you so much for being with us. Congratulations on your new post. I'm curious if you see this data that we got this week as indicative of the muddle that leads to that slowdown that you're expecting.
Exactly. I'm very happy to be here, Lisa. I think you all were talking about the economy is not the market, and I think that very much resonates with me. This was a crazy week for the economy. We started with Tuesday, inflation number, surprising to the upside, and everyone then completely forgot about that on Thursday, right? Like, we are back to new highs. And that's because this outlook we had of growth decelerating sort of came into picture on Thursday. January was so strong on all fronts that we spent a lot of time thinking, are we wrong here? Do we think deceleration will happen? Or are we going into this no landing thing that people talk about where growth continues to be super strong? And, 3.5%, 4% growth for the U.S. economy is double the potential capacity of the U.S. economy. So that was really our fear, that if that happens, that's great for the U.S. consumer and all, but what does that mean for the Fed? And the markets are driven more by what the Fed is up to and less by the,
What I'm struck with is if you really do believe and you have conviction in a slowdown that other people don't have conviction in, wouldn't you go full on into duration?
Not really at this point because of the inflation dynamics also, because, you're watching PPI, PCE comes in strong. That means rates are still under pressure. And that delays the Fed hike, and you don't really want that duration right now. Because the economy is slowing, but it's not recessionary. So that's the major difference, because if it was recessionary, then you would want a lot of duration on your portfolio.
So
not right now.
that takes it. You look at the forward drivers on employment, and this is something that you specifically look at, and you have concerns. You talk about those as being a strong indicator of a slowdown is likely to come, but yet it doesn't sound like you're looking for a hard landing. So what are the cracks in the labor market that I should be paying more attention to? Because unemployment rate is being very, very well behaved at the moment. Wages are fine. Wages are actually strong. So what are the cracks that you see?
So the cracks are really not on any of those metrics because those are really, I would say, coincident at best. So the forward-looking indicators to me are what's happening to the JOLTS number. That's indicating demand's coming down. And another thing we look at, it's sort of within JOLTS, hidden there, is the hiring rate. And if you look deeper into the hiring rates and its correlation to wages, hiring rate and quit rate, those things are coming down. That means wages are likely to come down. That means this super core component of CPI and PCE that the Fed is focused on, that's not going to be as worrisome. And that's what keeps me less worried about the hard landing scenario.
So then why, to Lisa's point, why are you not sort of more enthusiastic about duration at the moment? Or is it that you look more towards credit, perhaps, and that kind of the side of the market rather than full-on duration? Excuse me.
So you saw what happened when inflation number this week was bad, right? We saw massive backup in yield. And I don't think the market's fully priced in that potential yet, that, you know, we get a hotter PCE number for a couple more months. That then leads to this worry. And if rates go up, you see they're still super correlated to what's happening to equities. Rates go up, equities down.
Speaking of which, talking about sort of the inflationary impulse, you wrote in your research that we are worried about a potential risk scenario where continued conflict in the Middle East raises oil prices and makes it harder for the Fed to act this year. It's sort of the concern about, I don't want to call it stagflation, but stagflationary kinds of headwinds. Are you going more heavily into energy stocks to sort of hedge against this? It seems like this is the key hedge for so many different investors right now.
Yeah, I think you can call it stagflationary fears. Yeah, that's the word. That to us is a risk case. It's not the base case because, you know, these dynamics are well known in the markets. I think anyone who needed to hedge this has hedged already. We do have exposure to natural resources in our portfolios, and really just something as a risk scenario, not the base scenario. Watching it, that feeds into inflation and the same cycle again.
We spent yesterday talking about the UK, stagnation nation in the UK, a slippage in Japan into recession, and likewise in Europe. You talk about growth outside the United States of America is much more uneven. So that's in the numbers. But we see higher growth in absolute terms in China and an improvement in the nominal growth in Japan. I look at the velocity in Japan, 6,000 points rally in the past 4 months, twice the pace of the NASDAQ. That's from Martin Maloney, who's just sent that through to me. To what extent are you preparing to take additional global risk?
That's an excellent question. I would like market breadth to improve, right? So by market breadth, I mean not just concentration in NVIDIA and all the US stocks versus...
All hail NVIDIA.
The small cap stocks and other stocks in the US and value stocks in the US and everything that nobody has paid any attention to for a long time. Market breadth improvement to me would also mean market breadth improving globally.
Okay.
So in other words, that is very uneven also. Only Japan sort of seeing a revival. But if you look at EM index, it's down for the year. If you look at other parts of Europe and UK, they're showing some signs of life, but I wouldn't call it yet that market breadth has come back.
Adwaita Wahugana of Northern Trust, you are sticking with us, which we are happy to say. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. Travel is picking up in China due to the Lunar New Year, offering signs that spending might also pick up. More than 61 million rail trips were made over the first 6 days of the national holiday. That's up more than 60% from the same period last year. China's economy has been struggling with growth concerns amid deflationary pressures and the ongoing property crisis. Another major company slashing jobs. Nike is cutting 2% of its global workforce as the sportswear giant cuts costs amid a weaker outlook. It has nearly 84,000 employees worldwide. The layoffs are planned in 2 phases. The first kicks off today, with the second to be completed by the end of the 4th quarter. In December, Nike said it was looking to save as much as $2 billion. Amazon founder Jeff Bezos has sold more shares of the company. He offloaded another 12 million shares, valued at $2 billion. It brings the total he sold in the past week to more than $6 billion. Bezos hasn't explained why he's planning to sell as much as 50 million shares, but the timing is likely linked to his move to Florida, which has no capital gains tax. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Okay, we already talked about this. It's a tax reason, right, Anne Marie? I mean, that's obviously, it has to be. Okay, let's put that aside for a second. $6 billion is nothing to sneeze at. What is he buying? He has yachts, he has islands, he has everything. He's got spaceships. I mean, honestly, what more can he buy?
That's a good question. He's not saying what he's buying, and he's not saying why he's doing it. I think it's pretty obvious why he's doing it. He just moved from Washington State to Florida, 7% capital gains tax or a 0% capital gains tax. So he's saving millions of dollars. But yeah, I don't know what he's buying yet.
He's sending a strong message as well. You know, I will not be corralled. I will not be corralled. I'm the master of this company, and I'm the master of where we go.
Well, we'll be watching that $6 billion. If he's looking for places to park it, I have some recommendations. Up next, the White House urging caution in Gaza.
We continue to believe that under the current circumstances, without a credible plan, as the president said, to account for the more than 1 million Palestinians that are down in Rafah, a major operation in Rafah would be a disaster.
That's next. You're watching Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg Surveillance. Welcome back. Jonathan Ferro, Lisa Abramos, Anne Marie Herdern. John is off today. Manus Cranny joining us for the morning, which is a great thing, to parse through a muddled week, although of gains. And this really has been a key moment where maybe, yes, we are seeing more layoffs, although people maybe are getting hired, but stocks continue to rally as companies protect their margins and do buybacks and share dividends. Futures crossing that 5,000 mark solidly, up another 0.2%. The euro dollar is doing nothing, basically fluctuating, and 10-year yields higher by about 3 basis points. Under surveillance this morning, the White House urging caution in Gaza.
We continue to believe that under the current circumstances, without a credible plan, as the president said, to account for the more than 1 million Palestinians that are down in Rafah, a major operation in Rafah would be a disaster. We agree with that. And we're continuing to talk to our Israeli counterparts about what that plan might look like.
Here's the latest. International pressure mounting as Israel prepares for a major ground offensive in Rafah, where over 1 million Palestinians have fled. Rafah is believed to be Hamas's final stronghold. and location of an unknown number of Israeli hostages. Joining us now for some clarity, Norman Rule, former U.S. intelligence official, senior advisor to the CSIS Transnational Threats Project. Norman, always wonderful to get your thoughts. What do you make of recent reporting on some sort of walled-in area in Egypt on the border with Rafah? What do you make of some of the reports in the New York Times and the Wall Street Journal overnight?
Good morning. Egypt has been adamant that it does not want to see an inflow of Palestinian refugees. It has multiple reasons for this, ranging from the fact that the refugees may not leave, they would be very expensive to maintain in the international community, may turn away from its obligations. There would be militants among the refugees who could reignite the terrorism and all near insurgency Egypt faced in the Sinai. And you also have the issue that this would depopulate Palestine, and many in Egypt believe this is what Israeli hardliners seek. However, there has been history where Palestinians in Gaza have knocked down or exploded the wall and poured into the Sinai. So although the Egyptian government has denied that it's indeed building a wall, there is some reason to believe that they would build a fenced-in area that would allow some number of Egyptians to, Palestinians to flow into Egypt and then be kept there as temporary refugees until the situation stabilizes.
With a border wall in Egypt, Norm, potentially would come also Egyptian army to make sure that this is protected. What does this all mean for Egypt and Israel's peace treaty?
Well, Egypt has reportedly moved some number of personnel and armor into that area recently, but not to fend off an Israeli threat, but rather to bolster its security. So if Palestinian refugees did flow across the border, they would be able to contain the area. This happened in 2008 when Hamas blew up the wall and about half of Gaza's population poured into Sinai for a few days. The Egyptians can't have that happen now. Now, this said, the 1979 treaty is very sensitive issue in Egypt. Neither Egypt nor Israel would want to see this fall apart. But at the same time, Egypt and Israel must cooperate on terrorism and the tunnels in the border. So I think you're going to see quiet cooperation, heavy Egyptian rhetoric against Israeli troop movements and anything that might threaten Palestinian refugees pouring into Egypt.
When it comes to Rafah, the president and Netanyahu spoke last night, and the readout says that the president reiterated his view that a military operation should not proceed without a credible and executable plan for ensuring the safety of and support of the civilians in Rafah. Norm, how far apart is this gap between the Biden administration and the Israelis when it comes to this potential ground invasion?
Well, the U.S. has been consistent in such statements. At the same time, there's no evidence that the Israelis are going to pour in a conventional military force and conduct an operation that would, in essence, produce a cataclysm among such a heavily populated area. Approximately 1.4 million Palestinians are now gathered in about 17% of Gaza's geography. You can't attack that effectively without causing a humanitarian disaster. I think we're going to see Israelis attempt to move out the population. It will be difficult to identify alternative locations, and then to conduct surgical strikes against Palestinian leadership. About one brigade of Hamas remains active in Hamas, and they've got to in Rafah, and they've got to work against the tunnel structure underneath Rafah because there are hostages located there, Hamas leadership, as well as Hamas remaining fighting force.
Norm, good morning. We're also seeing rising tensions to the north of the country in the border. There's new salvos of missiles coming in from Lebanon, about 13 kilometers into Israel. How would you describe that flashpoint? Because this comes at a very tenuous moment in time. Will the Israeli pushback be significant, or how would you describe the tension on that border at that end of the country?
Beginning February 14th, violence at the Lebanese-Israel border reached a new high because of Hezbollah extending the distance of its strikes into Israel. But we're not yet at a point where either Israel or Lebanon or the Hezbollah would seek a Lebanese war. The Israelis continue to respond to such strikes, which killed an Israeli female soldier and wounded others by conducting surgical strikes within southern Lebanon against Hezbollah and other militant positions. And this week they killed two Hezbollah commanders, mid-level officials who had been involved in operations against Israel. I think this is how we're going to, this will continue to take place for coming days.
Norman, I got to say, all of this seems like it would be escalation in a previous time and place. What counts now as escalation when so many people are basically counting this as something that's simmering but that will get resolved?
You're absolutely correct. We need to keep in mind that there are 80,000 Israelis who have been displaced from northern Israel and 120,000 Lebanese from the southern Lebanese border. We're looking at a state where Hezbollah continues to believe that it can fire into Israel, and Israel will respond to retaliate and destroy those firing positions. The Biden administration is adamant that it believes that by reaching a ceasefire or some sort of an agreement that it will suck the energy from proxy attacks against Israel. I'm not so sure, but it does have some logic. At the same time, Lebanon is in a very terrible economic situation. It has no president. It hasn't for a year. It's got a caretaker prime minister. The Lebanese people and polities certainly don't want a war. So I think we're going to see Lebanese Hezbollah operate within that framework. There is a risk of an incident that produces a lot of casualties, and that then sucks in retaliation on both sides.
Norman Rule, former senior U.S. intelligence official, thank you so much. Anwini Bahugana of Northern Trust still with us, and one thing that we talk about is all of the cold wars that are turning into hot wars around the world. How do you work with this, given that there is so much uncertainty and you don't know the outcomes? Do you just assign probabilities? Do you invest in the military complex?
Not at our asset allocation portfolios at Northern Trust. We assign probabilities. Probabilities are also, we would need someone like Norman on our staff to know exactly how to do that. We're aware of this. Really not much you can do about it from a day-to-day market portfolio management point of view.
When you look at risk, you talked about risk to oil prices because of the Middle East. Isn't it more of a risk to have demand in China pick back up? Because that's really when prices would lift.
Exactly. Demand in China has been weak, and that would be a real sign of market breadth in oil also. We haven't seen commodities really do much in this last year or two also. That would be, at this point, Anne-Marie, a positive sign of global demand picking up.
Anwini Bahugana, thank you so much for being with us. Congratulations on the new post. We look forward to you coming back next. I do want to bring to you this headline just crossing that Russian opposition leader Alexei Navalny has died in prison. This according to Interfax. And Anne-Marie, this is someone who has been very carefully watched as being one of the main opposition speakers to Vladimir Putin. Do we have any sense, any more details at all?
No, but what I do see from his press secretary yesterday is that he was sent to punitive isolation cell, and it was for the 27th time as he's been in this latest installment of imprisonment that he was sent to this cell. Navalny has been able in the past to get individuals out on the street in Russia. If this were to be true, when Interfax is reporting, you have to imagine that there might be some sort of, a little bit, at least in some of the more cosmopolitan areas of Russia, some sort of social unrest. But this is something that is going to draw a ton of condemnation from capitals around the world.
We will follow this throughout the morning. Coming up, a look at where oil is trading in the midst of the conflict in the Middle East, other conflicts as well, with Amrita Sen of Energy Aspects. You're watching Bloomberg Surveillance.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Until the other most important data point of the week, because they've all been pretty important and pretty conflicting in terms of their message. We get PPI coming up. Welcome back. This is Bloomberg Surveillance. Anne-Marie, Manis-Cranny, Lisa Abramowitz. Jonathan Farrow is off today. Futures still rising up 0.2%. You can see bond yields climbing just a touch. No drama to end the week as people really parse through exactly what the Fed will do and what this data means. You can see NASDAQ futures outperforming this morning in a risk-off day where the Russell 2000 is underperforming. Yields, 2s, 20s, 2s, 10s, and 30s, you could say lifting across the board. Although, again, no drama. 2-year yields, though, around some of the higher levels of the year, 460, as people parse through just when the Fed can cut rates, given the fact that you are seeing some strength. And Manis, yesterday, we heard from Raphael Bostic of the Atlanta Fed, traditionally a real dovish voice, and he didn't sound that dovish yesterday.
No, he wasn't convinced that the trajectory, the train, it's not absolutely on target to reach its destination, and to that extent, you know, it's about the hesitancy in the Fed. They want more confidence in the Fed. You look at there is one big position out there by Jupiter. Jupiter have put on a massive treasury bet for them. They expect a hard landing, 400 basis points of a cut, because they look at the analysis of rate cutting cycles. And I don't know whether the debate is this: what is this rate cutting cycle going to be? What will it look like? Traditionally, you get between 350 and 375 of cuts in a cycle. We're nowhere near that in pricing. So this is where the market is at the moment. There's a number of divorces at play.
There have been a number of divorces at play and a number of people who want to work as mediators to maybe pick up a couple shekels in the meantime. Meanwhile, in the euro dollar, you are seeing this sort of stasis. And we've been talking about how this is the most boring pair in the world, just simply because it's very hard. You game out the model. Well, somnolent, sleepy, stasis, whatever you want to call it. There's really a question mark around the divergences in policies, the divergences of growth rates, and what's exactly going to drive that. Under surveillance this morning, on a related note, ECB Governing Council member Francois Villeroy de Galou warning that the ECB should avoid waiting too long to cut rates. So really talking more on the dovish side, speaking to a French newspaper, saying that the risk of moving too late exists at least as much as moving too soon. The comments coming with rising anticipation that the ECB may be the first major central bank to cut rates. And Manis, this is what a lot of people were saying last year, that the ECB would move first, and that, frankly, they have more reason to, just simply because growth isn't there.
Well, you just look at what the number that Nagel gave Germany in terms of their economic position, 4 out of 10. The slowdown in Germany, which was the bulwark of European growth. If you look at what Francois de Gallo says, Villeroy de Gallo says, 3 successive degrees of freedom can be another argument not to overly delay the first cut. Now, the question is how poor is the economic scenario in the Eurozone, and does it warrant faster and more aggressive cuts? And then that takes you to what European bonds are going to do relative to treasuries.
And I have to say, Anne-Marie, what this does to some of the prognostications that we heard from Ursula von der Leyen in the Financial Times, they want to spend more. Is this something that they can and have the willingness among some of the ruling parties to do?
Well, when you look at the European Union, you're looking at herding cats, right, when it comes to trying to get things over the finish line. But also, Christine Lagarde also spoke yesterday and said the last thing she would want to do is make a hasty decision, see inflation rise again, and have to take more measures. So it feels like there is a little bit of this push-pull. The worry is, do they go too soon or do they go too late? And they seem to be worried.
In another episode of Herding Cats, House Republicans saying they will not pass another stopgap measure in order to avoid a government shutdown. House Majority Whip Tom Emmer telling Bloomberg that negotiators in both chambers will continue to work on a framework which may include a series of spending bills. The House is in recess, of course, until February 28th because they're good at taking vacation. The Senate is also away next week, and we'll have to deal with the impeachment of Homeland Secretary Alejandro Mayorkas before working on a spending bill. You put this all together, Anne-Marie, talking about the muddle in markets, the muddle in D.C., is it going to come together for some sort of prevention of another government shutdown, or do we have to talk about that again?
We're going to have to talk about that again because Tom Emmer, the Republican Majority Whip last night, told Katie Lyons and Joe Matthew on Balance of Power that we're not going to see this continuing resolution. So they come back then on February 28th, and then the first tranche of potential spending that they did this two-parallel approach to potential government shutdown is March 1st. So they have 3 days. 3 days to get spending bills done. And to the point about Alejandro Mayorkas, once the Senate deals with that and there's a trial, they can't take up any other legislation. That's it. So they just don't have the time. But we have heard Congress say before, we're not going to do a continuing resolution, and then they do it. So
it's so much fun to cover the muddle. And all I can say is, on one hand, you want to say, who cares? Just ignore the noise and let's look elsewhere. But then other people will say, well, guess what's behind a lot of the rally that we've seen this year and a lot of the strength in the U.S. economy? It's a lot of the fiscal spending that we've seen continuing to play out. Apple, meanwhile, is racing to catch up with Microsoft in the field of artificial intelligence. Bloomberg reporting the company is on the verge of releasing a new software tool which would help developers compete with Microsoft's GitHub Copilot. The new system will use AI to predict blocks of code, simplifying software development. The moves come as Microsoft and Alphabet surge ahead with development of ChatGPT and Gemini. We've been waiting for Apple to come out with something. There is a question of whether Apple has underperformed because they haven't really been coming out with some sort of artificial intelligence, in the sense that NVIDIA is still the outperformer, and that seems to be the main theme, Manus.
Yeah, I mean, it comes down to how do you monetize AI if you are a phone and app company. And to that extent, what Apple have put on the table, or we understand has put on the table, is on the development side, not on the phone, not on the iPad, not on the product that is sitting around this desk. And if you look at what Galaxy have actually done, Samsung Galaxy, they have begun to imbue AI into their phones. If it's translation, interpretation, and in terms of imaging, and that's where the real zeitgeist is, because we spend our lives focused on the back of these phones. We spend our lives on Instagram, on the photography, and so that's where, well, some people do. No, I'm just a tortured soul on sort of, you know, social media. But if you talk about what Samsung are doing, they are making AI come alive for you, for me. I should go and work at sales.
Well, I will say, though, what's the better pitch, right? To be on the development side where you're actually
Well, I don't know what the bigger monetization process is.
Right now, it's NVIDIA, no? I mean, Anne-Marie, that's exactly what you're looking at right now, is that it's really with respect to the hardware, not the software.
Yeah, that's where you want to make the money. I think people are still trying to figure out how AI is going to, how they make money while incorporating into consumers' lives. And then it becomes, you know, Manus, you're talking about the iPhone, but then for Microsoft, it's going to be all about the search. Can they finally potentially go above Google and make Bing a real thing?
Well, and not just that, and we can talk about Bing another time, but we can also talk about what's going on with Google and why it is falling this morning in response to some search questions. Meanwhile, oil prices holding steady despite the ongoing war in the Middle East and a gloomy outlook from the IEA. Brent crude trading below $83 a barrel. This has been one of the biggest surprises after rising 1.5% on Thursday, a short-lived rally. WTI trading close to its highest price since mid-November. Amrita Sen of Energy Aspects joining us now, and I got to say, Amrita, this has been one of the most confounding stories out there in a midst of many, many confounding stories this year. What is this? Is this an issue of demand falling off, or is this an issue of supply that keeps coming and cuts that cannot be enacted in the way that OPEC Plus hoped?
Well, I mean, like you said, prices are trading at their